bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
You think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising
Yeah,
New York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Reality check. Global stocks and bonds digest two surprise rate hikes this week, reminding investors that the inflation fight isn't over. Wall Street may soon face fresh compliance costs in the United States after a reprieve from Europe's tough MiFID II rules expires next month. And a warning from BlackRock. Vice Chairman Philip Hildebrand says investors must reassess their allocations to China amid rising geopolitical tensions with the US and a slowing economy. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, I feel like saying, oh, Canada. You're dealing with the air quality issues, of course, from the wildfires in North America. But also on the markets, we're dealing with a surprise rate hike from the Bank of Canada coming close on the heels of the RBA's surprise.
Yeah, who knew Canada would have such a big impact in just a 24-hour span in terms of both Wall Street and Main Street, for that matter? Something, of course, we're going to digest throughout the rest of the show. But something really important to keep in mind is the read-through you are seeing from the Bank of Canada into what exactly the Fed pricing is. But look, it's not just the Bank of Canada. The RBA played a little bit of a role here as well. These surprise hikes to the upside really suggesting that, wait, maybe we got to hold on for a second and say, look, maybe inflation is not over. And if that isn't going to kind of increase those Fed hike bets, that's what you're seeing priced into the bond market and really led to the surprise on both sides of the border in North America yesterday. You're seeing that show up in the two-year yield a little bit, 455 here, because remember, overnight, Fed swaps are now pricing in a little bit more hawkishness from the Fed. Whether that translates into kind of a ripple effect for the equity market still remains unknown, because for now, you're kind of seeing the equity market remain flat from the S&P 500 and the NASDAQ futures perspective. But I threw on here and said, Russell 2000 futures, because Anna, still a big part of the conversation. It's not just inflation, it's not just growth, it's breadth in the stock market. And you are starting to see a little bit of that as those small caps get in on the rally, as shown by Russell 2000 futures, higher by 0.3% already in the pre-market. So those are some early signs that perhaps we can enter a bull market when it comes to equities. But again, the bond market could change the game when we start to price in those hawkish bets. I think the FX gauge is really crucial here because the dollar actually weakening. If you are expecting more hawkishness from the Federal Reserve, the dollar in theory should strengthen, yet that's not exactly what's happening. Weakness in the greenback to the tune of about 0.3%. A lot of international factors playing to that. We're going to get to that in a second. NYMEX crude, though, trading with a 72 handle, down about 0.5%. Again, reflecting a little bit of those growth concerns. But Anna, I mentioned the Asia story because it is absolutely hitting the dollar. Overnight, you saw Asia weak by about 0.3% overall in the entire region. So seeing that show up in the MSCI Asia Pacific Index. But again, I want to come back to the currency story because you also got some GDP data out of Japan, which we know has been dealing with growth concerns. They're actually posting better than expected GDP, saying the economy is actually recovering. Resilience is a factor. So you are seeing strength there in the Japanese yen, 139.74 on that crosspair. Outperformance in China, though, as we talk about that bid into tech, into AI, the CSI 300 really outperformed and was the outperformer throughout the entire region, higher by about 0.8%. But it's coming at a time when China is exploring stimulus, and this is a really big deal. A big chunk of Chinese lenders talking about cutting their reserve ratios, and that really potentially propping up the offshore yuan as well. So you are seeing that as well. 714 on that currency pair, Anna.
Yeah, and will we see further action from the PBOC? Bloomberg Economics certainly talking about the possibility of that by mid-June. Let's get to the European equity market picture. And whilst I show you this pretty mixed picture on European equities, I'll just go through some of the breaking news that we had on the euro area economy. Contracting by 0.1% in the first quarter on the quarter. So this is this Q-on-Q number, and I think that's 2 quarters of negative. So that would be a technical recession. So we'll get more details on that shortly. This is the picture across European equity markets. We've got the CAC going higher, the DAX going higher, shrugging off earlier weakness actually on European stocks. The IBEX and the FTSE MIB, just like yesterday, we're seeing outperformance coming through from some of these southern European markets. The FTSE much of a laggard this morning. So that's the picture in terms of the geographies. In terms of sectors, it's the higher yield story that still is having an impact. Yesterday we saw the Nasdaq underperform on Wall Street, and that is flowing through into the European session. Tech stocks, one of the weaker performing sectors today, and that sector is down by 1.1%. We saw yields in Europe go higher on that Bank of Canada surprise yesterday, and so maybe that move is done for the moment, and so yields pulling back just a little bit. I put in the German 2-year yield. Others are available. Broadly speaking, we're asking across the Eurozone at least, these yields coming off after those gains of yesterday. This is SBB. That's the real estate business that we like to talk about over in Sweden because it's been such an epicenter of concerns around real estate in the European market. That stock down by 9% or just shy of today. Yesterday it rallied by more than 7% on comments from the new CEO suggesting he wouldn't sell assets at fire sale prices. Today the stock goes down, S&P downgrading the outlook, and it goes further into junk. Wizz Air, this as the name suggests, an aviation company based in Europe, listed in London, up by 1.4%. It was up by more than 4% earlier on, Kriti, as yet another aviation company tells us about the strength of the sort of booking pipeline ahead and prepares itself for a busy summer.
Yeah, resilience seems to be the theme across Main Street around the world, Anna. But on Wall Street, a little bit of a different story, headed for a regulatory fight over how clients pay for investment research when a reprieve from Europe's MiFID II rules expires next month. Joining us now is Bloomberg's Leonard Kenscherper. Tell us a little bit about the background to the story. We know that Europe and the U.S. have really disagreed on this front in the past. What are the developments here?
Yes, exactly. So these MiFID II rules say that brokers have to charge separately for trading and research. And so far, I think for the past 5 years, the SEC has shielded US brokers from that requirement because it would basically mean more costs for these firms. And now that reprieve, that shield, is going to expire next month, and we're already seeing a bit of pushback from the industry, and it will be very interesting to see how that plays out, because Gary Gensler said, don't expect a further extension.
Yeah, Gensler certainly suggesting, you know, we've told you this, we told you it's coming, get ready. Now, on another subject of interest in the financial services sector, Standard Chartered trimming more than 100 roles as part of a cost-cutting plan. Which are the roles that are affected here, and what are the particular catalysts that we're hearing?
Exactly. So in Asia, our colleagues report it's going to be HR roles, and in London it's going to be a few managing directors in financial markets. the company said this is part of their normal review of business, of course, but it also comes against the backdrop of a drop in trading revenue in the first quarter, and also against the backdrop of these gloomy forecasts that we've seen from US bank executives last week, for example.
Yeah, certainly been a theme, job losses in the financial services sector. Leo, thank you very much. Bloomberg's Leo Ken Sherpa with the latest on those themes in finance. Now, around the world, investors are struggling to process how to deploy capital as recession risks and geopolitical tensions shake global markets. Earlier on Bloomberg, BlackRock's Vice Chairman Philip Hildebrand said investors must reassess their allocations to China.
Certainly the fragmentation of global geopolitics, in a sense, and at the core of this, of course, is the tension between the US and China, means that you have a very different set of assumptions when it comes to allocating. So what might have been, an obvious kind of play to say we need to increase allocation to China is now has a different calculus driving it, given the clearly the increased political risk premium.
Joining us now with analysis, Bloomberg Markets reporter Justina Lee. How widespread is that view then, rethinking allocation to China, either because, Justina, of the geopolitics and those longer-term concerns, or around the lack of momentum behind the Chinese rebound from reopening?
Yeah, I think those concerns are pretty widespread right now. I mean, as you said, one part of the story is the cyclical part. We all know that Chinese economic recovery has been sputtering, recently. And on the other hand, I think more worryingly is the long-term structural story. And one part of that is, the worsening relations with the U.S. And the other part of that is, China's aging demographics and the drag that could be, on growth going forward. And we can see this all over Chinese markets right now. I mean, in terms of Chinese stocks and the Chinese currency, I mean, those have really suffered in recent months.
Justina, so that's the China story. We talked about kind of the structural piece there. I want to bring to you the Japanese story as well, because it feels like right now when we're pricing in bets for the Federal Reserve, the market is kind of taking its cue from the Bank of Canada, the Australian Reserve Bank as well. Where does Japan's kind of better than expected growth fall into kind of the global growth story?
Yeah, Japan got some pretty good GDP numbers recently, and that was driven by stronger corporate investment. Even though at the same time, there were some bad, signals kind of hiding in that data. For instance, inventories are going up, and that tends to be a sign that demand is not keeping up with production. I think for now, people kind of expect the BOJ to kind of not rock the boat. There are also political questions coming in here because a lot of people have been speculating that maybe we're going to get a snap election while, the numbers look good in Japan. And so I think, overall still good news, like what we're seeing across the developed world. But I think the question is, where do we go kind of going forward, especially with perhaps, inflation starting to weigh on consumption as well.
Justina, thank you very much. Bloomberg's Justina Lee with those market themes from China to Japan. Let's get back to some Western politics. UK Prime Minister Rishi Sunak wooed US business leaders and politicians as he engaged in baseball diplomacy, we're told, the day before he meets President Joe Biden at the White House. Joining us now, Bloomberg UK Economics and Government Managing Editor Brendan Scott with me on set. Rishi Sunak there in those images doing a good impression of a baseball fan for somebody who actually prefers cricket. What do we make of this so-called baseball diplomacy? It makes me think of US-Cuban relations or somebody showing up at your house with a baseball bat, neither of which are intended connections here. So what do we make of this effort?
I think what you're seeing there is someone who's trying to show that he's familiar with America. He's a Stanford grad. He's someone who's comfortable in an American setting. He also wants not just the American people, but the decision makers in Washington to see that he's to get to know him a bit better. He's only been prime minister since October. He hasn't had much chance to interact with the US's decision makers on a one-to-one level, and so this is a chance for him to really do that and show that to the world as well.
Talk to us a little bit about the technology frontier. It feels like perhaps the UK in some ways feels left out of that global conversation. Where does Sunak stand on that relative to the US?
Yeah, of course, the UK, London are big tech centers themselves. There's a lot of investment here. There's a lot of people involved in the industry in the UK. Rishi Sunak's trying to leverage that, trying to get himself in this conversation, which right now is being dominated by the bigger blocs, the U.S., Europe, and of course China. So this is a chance bringing up AI in this context. He sees this as a source of common ground potentially between him and Biden, and potentially a way to steer the conversation, which has been very security focused since the start of the Ukraine war, towards something a bit more economic.
Yes, and so he wants to base a sort of AI regulatory hub in the UK, doesn't he? So we'll see where that conversation goes. Brendan, thank you very much. Thanks for joining us. Bloomberg's Brandon Scott with the latest on the UK politics and that visit to Washington. Coming up, investors reassessing rate hike bets as the Bank of Canada joins the RBA with a surprise hike less than a week away from the Fed's decision. More on that next. BlackRock's Jean Boivin seeing rates higher for longer, with any cut unlikely this year. That conversation is still ahead. Plus, the Super Return Conference is in full swing in Berlin. We will bring you our live interview with Joe Taylor, CEO of the Ontario Teachers Pension Plan. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. From the Wizards and Capitals to new ventures and innovative investment, running a sports empire in Washington, D.C. is a monumental task. Owner Ted Leonsis trusts CFO Peter Bichet to execute monumental sports and entertainment's financial game plan.
We are definitely in growth mode. What else can we do? How do we grow the platform?
Watch Chief Future Officer, Wednesday on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, it's been an interesting 48 hours because the narrative has completely changed when it comes to central banking around the world. You can blame the Reserve Bank of Australia and the Bank of Canada for that story. It has a very real read-through into the markets, which brings me to a chart. For our radio audience, stick with me here. We are looking at global bond yields, essentially on the front end of the curve, kind of normalized here, but basically what you need to know. Yields, Canada, U.S., Australia, Germany, New Zealand, basically a lot of these major economies, the yields are going up, up, up. And a lot of this has to do simply with repricing what these central banks are going to do, that we are not near the end of this global monetary tightening regime. Instead, we may have much, much farther to go. And this is extremely important in the context of the Federal Reserve because, of course, we do think that, well, the Fed kind of does its own thing, given that it has the backing of the dollar being the reserve currency for the world. But to what extent do they need to start kind of ripping a page out of playbooks from other central banks around the world? And that's where you're starting to see a little bit of the pricing change. On this topic, I want to bring in a true expert. Bloomberg's Phil Serafino, a fellow American, I might as well add, joins us now to break it all down. Phil, you're an American. You know all about American exceptionalism, the idea that perhaps the Federal Reserve will be different at the end of the day. Will it? Talk to us about pricing here.
Yeah, I mean, the message you're getting from Canada, from Australia is, hey, inflation is still a problem. We need to bring it under control. I was looking at the headline inflation rates around the world. The U.S. 4.9%, the euro area 6.1%. That's way above what the central banks want to see. Everyone says inflation should be around 2%. So that tells you that there's probably more rate hikes coming. The case can be made, look, there's been a lot of increases already, and that's working its way through the system, and inflation is coming down, and it will keep coming down. But, central banks are not going to sit back and take a chance that they get behind the curve, and that's the message you've seen this week. Rates are going up.
And if you're a government and you need to raise money, Phil, and you are also increasingly making the assumption that rates continue to rise, you might decide to issue now rather than wait. And we're seeing quite a lot of issuance, not least here in Europe.
Yeah, this week alone, sovereign issuers in the U.S. sold $27 billion of debt, busiest week since 2020. So they are clearly taking advantage of this moment now before they see another round of rate increases coming. This week in Asia, there's been a big bout of corporate issuance as well. So the debt capital markets are really, issuers are rushing to borrow that money now before the interest rates go up.
Phil, are they going to be met with appetite, though? Isn't the story of liquidity and digesting this issuance around the world still a big issue?
Yeah, I mean, that can be a problem. There's been a lot of concern about that. I will say, though, it seems like there has been a lot of appetite for especially high-grade bonds. You have buyers like insurance companies that have been starved for years when rates were low, and they still have an appetite for debt. The question is, when do we hit that tipping point when it's just too much? So far the market has been very receptive to these issues. We'll see how that goes if there's a little bit of stress in the system as rates go higher.
I know that we've got some comments from Ray Dalio on that subject. We'll play those later in the program. Phil, thank you very much. Phil Serafino joining us there from Paris. And for more market analysis, check out the Markets Live blog. You can find that by typing into the Bloomberg terminal MLIV Go. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Be
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Some 230 square miles of Ukraine's southern Kherson region is underwater 2 days after the destruction of the Kakhovka Dam. The regional governor says almost a third of the flood zone, where thousands are being evacuated, is held by Ukrainian forces, while the rest is in Russian-occupied territory. Kyiv is assessing the humanitarian, economic, and ecological damage of the disaster that Western leaders denounced as a war crime. Bloomberg has learned a mood of deepening gloom is gripping Russia's elite about prospects for President Vladimir Putin's war in Ukraine. Many within the political and business elite are tired of the war and want it to stop, though they doubt Putin will halt the fighting, according to 7 people familiar with the situation who asked not to be identified. The mayor of New York has told residents to stay indoors or wear N95 masks if they go outside, as the most polluted air in decades blankets the region. This is as wildfires continue to ravage large tracts of forest in Canada, sending smoke more than 1,000 miles southwards. Prime Minister Justin Trudeau says it's the worst wildfire season in Canada's recorded history. House Speaker Kevin McCarthy called off votes for the remainder of the week and sent lawmakers home. A revolt by Republican hardliners halted business in the chamber for a second day. The blockade by a band of 11 ultra-conservatives heightened tensions among Republicans following the Speaker's backing of a compromise with the White House to avert a U.S. debt default. The Speaker says he was blindsided by the revolt. Soccer superstar Lionel Messi is reportedly planning to join U.S. Major League club Inter Miami. The Argentine legend revealed the move to Spanish newspaper Mundo Deportivo. It would mean he's foregoing a contract in Saudi Arabia worth a reported $400 million a year. The newspaper says Messi's being offered profit-sharing agreements with Adidas and Apple, and ESPN even says he may get a stake in the club, joining co-owner David Beckham. A fascinating story, Anna, just on the heels of so much kind of sport enthusiasm coming out of the Middle East. I mean, we'll talk about the U.S. story and angle in a moment, but this is coming on the heels of the merger between the Saudi-backed kind of golf tournament with the PGA Tour. This is coming on the back of Cristiano Ronaldo in Riyadh right now, playing for a Saudi team. And of course, last year, the FIFA World Cup held in Qatar. It's fascinating how sports are kind of taking over the Middle East.
Yeah, and the role of these big Middle Eastern players is really interesting, isn't it? Our big take story today actually features the world of global football, of soccer, and talks about the billionaires who are buying up these clubs. And in that, we've seen quite a lot of success from those from the Middle East. So, for example, the Saudis buying a team in the northeast of England with quite a lot of focus news-wise on that. We've seen the Qataris still going after Manchester United, coming hot on the heels of their World Cup success. So clearly looking to exercise that soft power by both buying clubs and attracting talent to their home teams. I wonder, though, in the Messi situation, you know, you can take the geopolitical view and say, look, he can turn down those Saudi dollars in the way that the PGA Tour can't. Or you can just maybe draw the conclusion that he prefers Miami. He'd just prefer to go and live there. Who knows? Maybe we'll find out one day.
It's a very common move that a lot of people are making, even out of New York, even out of California and Texas as well. I'll also add the fact that there seems to be this kind of influx into bringing a lot of these very popular sports in Europe to the U.S. I want to say Formula One, for example, also trying to make big bets about getting bigger in the state. So to see that extra backing behind David Beckham now as well in terms of Inter Miami, that's enormous for the U.S. soccer market.
Yeah, absolutely. So we'll watch how this plays out for Inter Miami themselves. Yeah, really fascinating to watch the way that the US game is growing, and David Beckham clearly there and trying to drive some of that on the global stage. So fascinating story to continue watching. We were just at the Super Return Conference yesterday with Danny Berger, and we'll be there again in moments. But she was talking just yesterday about private equity interest in the space. Plenty of PE money going into sports of all varieties, we heard in yesterday's conversation. Coming up, we'll talk to Jean Boivin, head of BlackRock Investment Institute. We'll talk about the rising yield environment. This is Bloomberg.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lines.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power. Every weekday at 5 p.m. Eastern. Only on Bloomberg. Your global business authority.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Reality check. Global stocks and bonds digest two surprise rate hikes this week, reminding investors that the inflation fight isn't over yet. Wall Street may soon face fresh compliance costs in the U.S. after a reprieve from Europe's tough MiFID II rules expiring next month. And a warning from BlackRock Vice Chairman Philip Hildebrand saying investors must reassess their allocations to China amid rising geopolitical tensions with the United States as well as a slowing economy. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot to digest around the world, but for some reason, the RBA and the BOC really threw markets for a little bit of a loop here.
Yeah, absolutely, they did. And what was interesting when you saw the reaction in the Australian bond market, it was actually more to the Bank of Canada than it had been to their own domestic rate hike story. So that gives you some sense of the way that this story of higher yields has sort of gained momentum as we've gone through the week and been reinforced perhaps in investors' minds. This is the Stock 600 right now, down 0.1%, a little bit lackluster. Is that rising yield environment capping our expectations for stocks? Perhaps it is. Certainly capping technology stocks right now. That was the theme on Wall Street yesterday. We saw the Nasdaq down by more than 1.2%. Here in Europe, it's the theme today with technology names under pressure in today's session. The German two-year yield, just like many of the parts of the sovereign debt curve in the Eurozone, we saw yields rising yesterday on the back of those surprise rate hikes. But we kind of digested that, and for the moment, just pulling back a little bit. So we're just down a basis point or so on those yields. Still, after the RBA and the BOC at higher levels and rethinking what we expect in terms of the global rate hiking cycle. Wizz Air, this is an aviation business, as the name nicely suggests, here in, listed in London, based over in Eastern Europe. And we see it is up by 1.7% today after it followed hot on the heels of a host of other aviation names then, Critty, talking positively about the summer that's still to come. Critty?
Consumer resilience that is still fueling perhaps those more hawkish bets around the world, and specifically when it translates to the Federal Reserve. I'll get to that in a moment, Anna, but when we're talking about sentiment in terms of today's trade, a lot of that seeping into the U.S. as well. You are seeing futures virtually unchanged right now, 42.74 on those contracts, but a little bit of outperformance in the small caps. And that is a positive sign for the bulls who are saying, look, we're waiting for that breath in the market to show up. Well, you kind of got it. Now the small caps are playing a little bit of catch up to those big, heavier growth things. But again, inflation is the story. Growth is the story. And that's really where those Fed hike bets really matter. The two-year yield at about 4.55 here. Overnight, though, if you look at the swaps market, they are now pricing in a little bit more hawkishness, something that isn't necessarily showing up on the surface of the bond market just yet. Something to keep in mind, especially as we talk about the ripple effects for the greenback. The Bloomberg Dollar Index directionally, at least, following the story of the yield curve, down about 0.2%. What's interesting is the weakness in the greenback not necessarily having a positive effect on the commodity market. NYMEX crude still trading with a 72 handle, Anna, down about 0.4%.
Okay, so those are the markets. Let's get to some analysis. Bridgewater Associates founder Ray Dalio says the U.S. is seeing stubbornly high inflation along with elevated real interest rates. He spoke yesterday at the Bloomberg Invest Conference in New York.
We are at the beginning of a very classic late big cycle debt crisis when the supply-demand gap, when you're producing too much debt, and you have also a shortage of buyers.
Ray Dalio there. Let's get to Jean Boivin, head of BlackRock Investment Institute, who joins me on set here in London. Jean, very nice to have you with me today. Let me start by asking you about this theme that Ray Dalio is talking about there, about levels of debt coming in particular out of the United States, but elsewhere, of course. I mean, we're seeing plenty of demand for those T-bills this week, some of those auctions going pretty well, so maybe no lack of demand now. But bigger picture, are you concerned about the potential for a lack of demand as we see governments in Western countries issue so much?
I don't think this is the concern of too much demand is an issue for the near term. I mean, markets are pretty relaxed about the debt picture. You know, this is one of the things that hasn't, the dog that hasn't barked is record level of debt, and yet, you know, investors very happy to get exposed, buy more of these government debts. We've seen yields, you know, falling actually or being flat throughout the year, despite central banks raising rates. So I think this story is one that is on the radar. I think that is something that will be a market driver eventually. But in the near term, I think this is more of a central bank story and how they're going to play.
Right. And thinking of that central bank story, we've had a real reminder this week. Even if you get a pause, even if you get a skip, that doesn't mean you're done with hiking. We got that from the RBA and we got that from the Bank of Canada. Does that have read across? Is the market right to build up expectations of Fed rate hikes in the wake of those moves?
Well, from our perspective, the biggest disconnect this year was the fact that the markets were expecting some quick easing cycle to start, rates to be cut by the Fed, despite the fact that, in our view, we haven't made any progress really on inflation. Core inflation over the last 6 months have been basically moving sideways at a level that is not satisfactory, 5% type. So that disconnect has been now, you know, disappearing. We've seen the market in the last few weeks start to move and price out these cuts. I think the Bank of Canada is adding to this, confirming that, you know, this is a world where inflation problem is not being resolved yet. It's going to require at least central banks holding steady and keeping rates at the level that they are right now. So the high conviction is no cuts anytime soon from our side. And the risk is towards a bit more hikes to come. And I think the Bank of Canada, in this context, a bank that was trying to pause, you know, has really positioned for that, and now has kind of been forced to re-engage in hiking, shows that, you know, that I do think there's a read across from that.
Sean, in addition to kind of the changing narrative around these central banks, as you just pointed out, talk to us a little bit about the liquidity picture here. As we see another big jump in issuance, both from sovereigns and corporates, is there a concern about digestibility in this market?
Yeah, I think we're there is a bigger dynamic at play in the liquidity banking sector picture. We have certainly the debt ceiling being behind us now. We're going to see a lot of issuance coming back to the market. That's going to be happening very quickly, and it will be something to watch. Could create some pressure. I think beyond that, we are seeing a dynamic over the last year since the Fed has started to raise rates that has been putting pressure on the banking sector. We have seen deposits outflows from the sector, in the tune of 800, 900 billion, close to $1 trillion now of deposits outflow from the system. So you put these things together, and I think that's an environment where we are seeing tightening of credit condition, liquidity conditions, and I think that has more to play out, and it could come with some volatility along the way as the market digests, these issuance over the next few weeks.
What about the pressure theme from China specifically? Is the Chinese read-through into some of these Western economies the same as it was, say, 10, 15 years ago? How are you thinking about that side of the world?
No, I think this is very different. So, when you go back over the last 10, 15 years, you were trying to think about China in terms of how much of a cushion you can get from, even if we were going into a tougher spot in DM economies, how much of a support cushion you could get from China. I think this is a very different story now. First of all, the growth dividend from China on the international market, I think, is lower than it used to be, given the geopolitics that is happening, the rewiring of globalization that we're going through. That's certainly one thing. And then also, I think the domestic resilience of the Chinese growth is more at risk now. We used to say the farther away you're from China, the more bearish you are. I think this environment has been flipped. That has been flipped a little bit. I was in Asia last 2 weeks, and it's a bit the opposite. I think the closer you are to China, the more you feel some concern, and the Chinese consumer is clearly showing lack of animal spirit at this juncture. So these are the big questions. So I think it's very different, and less support from the global economy from China, I guess, in this tougher environment is for us the bottom line.
Some really interesting perspective then on China following your visit. Jean, let me ask you about AI and your expectations. There's a lot of either hype or excitement, depending on how you see it, and a lot of that increasingly built into stock markets. Do you see this as a technology that could be deflationary? I talked to one guest who came in from Federated Hermes, who was making that point, saying that this could be something that reduces the way that the tight labour market and high wage or rising wage story is filtering through into inflation. We might have to wait some time, but is that where we're heading?
So I would start by saying that I think this market environment is one where this is less about the macro environment and are we going to see a recovery, recession over the next few quarters. I think it's more about mega forces. AI is one of them. I think we're thinking of the climate transition as being another one. Geopolitics, globalization, reward. These are all big forces at play. I think they all have implications for inflation. The globalization reward that we think is inflationary. We're going to see higher cost of production globally. Demographic is, at this juncture for us, inflationary. We're seeing a lot of tightness in the labor market because of demographics. AI is a third force. Eventually, I think you can tell the story where we're going to get productivity gain. We're going to be able to produce more efficiently. That could be reducing costs and be lowering inflation. But before I get convinced on that, it's going to take some time. And I think this is a story for maybe 5 to 10 years down the road, as opposed to the inflation problem we're facing now.
Okay, I'll ask you that again then in 5 or 10 years. Jean, thank you very much. Thanks for coming in. Jean Boivin of BlackRock Investment Institute. So we thank Jean for joining us today. Coming up, we will be back to the Super Return Conference, our live interview from that conference in Berlin with Joe Taylor, CEO of Ontario Teachers Pension Plan. Danny Berger will be back with that shortly. Plus, we'll have more from the Bloomberg Invest Conference in New York throughout the day, including Kriti's panel with executives at Nuveen, Blackstone and Lazard on managing pressure with alternative perspectives. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
I'm honestly most looking forward to my relationships with the founders. I'm really fascinated to hear their backstory. I'm a storyteller. I'm so excited just to have the opportunity to help them win.
That was Kim Kardashian presenting her debut private equity fund to a sea of curious investors in Berlin at the Super Return Conference yesterday. Bloomberg's Danny Berger is at the conference and joins us now with CEO of Ontario Teachers Pension Plan, Joe Taylor. Danny, take it away.
Okay, that's right. I am here with Joe. Let me tell you, he's just as popular at this conference as Kim Kardashian is. Crowds around him, too. Maybe less security guards, though, Joe. It's so good to see you. Thank you so much for joining. Look, we've talked about this a lot, just Ontario Teachers being a different beast. I mean, you're so large, you invest in many different things, you're like a hedge fund. So let's talk about the private equity portion of that. This year and beyond, have you rethought its place in your portfolio?
Well, we're very thoughtful about private equity because it's a large part of our portfolio. It's about 60 billion of almost 250 billion of assets at the end of last year, which was our last published numbers. I think the issue for us in private equity is, rather than looking at some of the challenges, try and see where we can provide good solutions. So we're talking to private equity firms about helping them with their liquidity. So that's either investing in their funds as an LP or actually trying to help them to sell companies to a responsible owner where we can take it on either with their continued involvement or on our own to the next level as a longer-term provider of funding.
And on the investment side, what type of fund right now do you see that's returning alpha? Who's doing a good job in a difficult environment of still delivering returns?
Well, I think a lot of private equity firms need to ask themselves, why are they distinctive? It's the same we ask ourselves, what sort of brings out the best in Ontario Teachers within, say, the pension fund community. We would probably say that for us is our agility, as you alluded to a minute ago. So if I go back to your question on private equity firms, I think what we're looking for is somebody who has a distinctive investment style, has good returns in terms of proven track record. But I think what the community can really think about is how well do you partner with people? So if you can actually have a trusting working relationship with partners, I think that broadens your opportunity set. And for us, it's all about trust. If we can work with people where we think we've got a good dialogue and we can work together to actually find a better way for the businesses we're both invested in, that's a great result.
Now, I know we're here in Berlin, far away from Canada, but Canada has had an interesting week on a macro scale. Bank of Canada, surprise hike yesterday. When it comes to inflation and a peak, a pause, an extended pause in interest rates globally, have we been a little bit too sanguine on the end of rate hikes, the peak of inflation?
Well, we've said for a little bit we didn't think that the rate hikes were over. So we weren't hugely surprised by the Bank of Canada's 25 basis point lift this week. I think it's quite likely to occur again in the US. we're very much in the mode of inflation's going to be stubborn and around for longer. Interest rates, therefore, need to also be high for longer to try and correct some of that. So what we're trying to do with all of that is say, where are the opportunities? Where are the businesses where they have something of a tailwind rather than facing headwinds at the moment because of those two activities, higher interest rates, higher levels of inflation.
Are you worried about a recession?
I think we're anticipating there will be recession. Are we worried about it? Well, it will have an impact on some of our companies. We need to help them through that. The beauty about being a long-term patient provider of capital is we can work our way through it.
But of course, it's not just private equity. As I mentioned, you're in so many different asset classes. So how do you protect yourself if there is a recession, if there is a worse downturn?
Well, the beauty about being in lots of different asset classes is where some are struggling, others will benefit. So if you look at our approach, we've been relatively creative investing in commodities, investing in alternatives to fixed income, particularly things like infrastructure investing. And our big issue, if we look to our own issues, are inflation is a challenge for a defined benefit pension plan of our scale. So whatever we can do to mitigate the impact of inflation, we'll be pretty actively looking at that.
You haven't mentioned public equities. How do you feel about them? How has your exposure to them changed this year?
So about 25% of our portfolio is in equities. The lion's share is in private equity, about 70% of that number. So our allocation to public equities is already quite light. I think we've seen more recently, in terms of the rally in public equities, it's been very concentrated in, again, a few mainly technology stocks. The rest of the market is, I think, not really progressing as strongly as people imagine.
Are those the mega cap tech plays? Okay.
Yeah. So the FANG stocks, essentially. And I think for us, what would we say? I think we would say that there's probably more risk on the downside than there is opportunity on the upside at the moment.
Are we talking like a correction, a further bear market?
Well, we've been speculating whether there would be a correction really since the fall of last year. So for us, it's a little bit overdue. So why would we think that? We would see risk in the Ukraine, which is still a situation in Europe that's not been resolved. And there are other issues on the horizon. I think food's an interesting one, which could actually be another catalyst for some economic correction. But I think overall, interest rates is probably what's going to drive down spending from consumers.
Right. And Joe, you've of course invested through a few cycles yourself. How do you feel about this new generation, which has had to deal with work from home, has had a lot of disruptions? The folks at Ontario Teachers, how do you think about the new generation's ability to deal with this downturn we're in right now?
Well, I'm learning, I think is the honest answer. I have to sort of reorientate to try and understand what Generation Z and beyond, going backwards, are looking for in life. I think they have more flexibility. I think they have more views of what they're looking for in an employer. So we try to portray very much our purpose orientation as an important way of attracting and retaining those people.
Are you hiring from banks, speaking of which? You've been letting folks go.
I think we're hiring from everywhere. For us, what we want are both people who are financially literate, but also people who can innovate. And I'd say in terms of your question, to me, the really interesting thing is what younger people want to buy and invest in these days is a little bit different. So you've seen a really big change in, say, travel as a driver of value. So, we own 5 airports, and actually it's really been the leisure travel that's driven the recovery more than business travel.
Okay. Joe, I'm afraid we're out of time. Really great to catch up with you. I know you're sick of me. We've done a panel. We've done this interview, so I'll let you go. And that is Joe Taylor, CEO of Ontario Teachers Pension Plan.
Danny, thanks very much. Danny Berger joining us there from Super Return over there in Berlin. Now, coming up on the programme, can Uber go all electric? We'll bring you our interview with the CEO, Dara Khosrowshahi. That's coming up next. This is Bloomberg.
let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Uber wants to cut emissions to zero by converting its entire fleet of cars to electric by 2040. But to do so, the ride-hailing giant will need support from both drivers and riders. The CEO, Dara Khosrowshahi, explains the company's new sustainability features to Bloomberg's Emily Chang.
It's pretty significant. Generally, the footprint is based on essentially all the miles driven. We completed 2 billion trips this last quarter. And we've got to do everything that we can in order to reduce that footprint, and we've committed that by 2030. In the US and Europe and Canada, we're going to be all electric. And by 2040, we're going to be electric all over the world.
That's an ambitious target.
Uber wants to cut emissions entirely. So for this ride-hailing giant, that means getting to total electrification, which would be nothing short of a green miracle. It's all part of the company's sustainability agenda, called Go Get Zero.
So let's paint the whole picture for me. This whole Go Get Zero push. What's the goal and how will you get there?
The goal is to go electric and create the incentives for drivers to go electric as quickly as possible and riders to pick electric as well. So the smart charging technology is allowing drivers to know when and where to charge, to feel safe to get routes that are efficient.
Yeah.
Then on the rider side, one new feature that we're introducing is actually a feature for you to see how much you're saving in terms of emissions. So when you get that green car or when you get that Comfort Electric, we'll show you how much you're helping out the environment, how many emissions you're saving. We have to get that flywheel together. We need drivers to choose electric, and then we're going to put more and more electric options in front of consumers as well.
How much more does it cost to ride electric?
If you're taking green, actually it's the same exact price as an UberX.
So are you taking the hit on that, or does the driver take the hit on that? Where does that cost?
We take the hit. So we've said that we are investing $800 million in the transition to electric, and we've got to make it economically sensible for drivers. So for example, our take rate on electric rides is lower because right now generally EVs cost more than combustion engines.
Right.
Emily Chang there speaking with Uber CEO about the company's electric future. And we should note, tonight is the premiere of The Circuit with Emily Chang. You can catch that new show every Thursday at 10 p.m. Eastern Time on Bloomberg Television. A quick check on these markets here. We are seeing futures virtually unchanged when we look at S&P and the NASDAQ. But the Russell 2000, those futures outperformed by 0.2%, 10-year yield, 379. That's it for early edition. Surveillance is ahead. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Absolutely think that growth is going to slow from here.
You have, we believe, a slowdown coming, potential recession.
Inflation, it's coming down, but it's going to remain elevated.
The reality is there's just a lot less upside left in this rally and potentially meaningful downside.
We do think something else will break between now and year end.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Can you sing "Oh Canada"? Can you sing that?
Big question.
You know the lyrics?
Yeah, no, Canada.
Nice. Blame Canada. Blame Canada for the smog. Blame Canada for the bond market rout. Live from New York City this morning. Good morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market just about positive on the S&P 500. TK, blame Canada. I think we need to talk about the bond market first. Blame Canada with a surprise rate hike from the Central Bank of Canada following a surprise rate hike from the Australian Central Bank earlier this week. And TK, all of a sudden, the bond market gets a bit more jittery.
Central banks like surprise. David Dodge invented this in Canada years ago. Jean Boivin is expert on this. I believe he was with the network yesterday. And the bottom line is surprise always is more efficacious for a central bank than something choreographed out like the idiocy of the dots. And the answer is they surprised yesterday. And you wonder, do we skip pause or do we light a bonfire at the Eccles building June 14th?
What's amazing about this is they communicated a conditional pause back in January and then delivered this line just yesterday, that monetary policy was not sufficiently restrictive to bring supply and demand into balance. And Lisa, there was a question I think a lot of people asked themselves yesterday. Is that statement in Chairman Powell's future?
Exactly what seemed to be sort of implied in the market. And if they're sort of committed to a skip, what does that mean for the July meeting? We now have a full rate hike baked in for July. And really, this has been the past few weeks of pricing out rate cuts. And I think that has been the theme. It continues to be the theme. Now, just how high will the Fed
go? And what's interesting is some of the Fed speakers in quiet period, they're sitting at LaGuardia because they can't get back to Washington. The situation this morning, John, is extraordinary. And I really want to lead where it's grim. Philadelphia.
Sure.
It is so bad in Philadelphia compared to what we're all living in New York. And the ratios of this, I have an offspring in China, so he taught me how to keep track of this stuff on the iPhone. And the answer is it is unmeasurably grim. And I don't know when it ends. I mean, when do the fires stop in Quebec?
A scorched earth. I was going through the numbers, Bloomberg putting them together, Tom. 9.4 million acres of burnt land in Canada, according to the Canadian National Fire Database. TK, double the size of New Jersey. We're talking about a lot. A lot and far away as well. We don't need to do the weather forecast. Rob Carolyn, who is absolutely giant on this, is scheduled to join us
He's been just a strong supporter of surveillance over the years. But the answer is, like you say, the scale of it. And I don't know, do we say something, the wind shift, the low off Nova Scotia goes away and the wind shifts on Saturday? This is all a distant memory? I don't know.
Kind of shocking, the last 24 hours. Yeah. Let's whip through the price action. Nothing too shocking about that in the equity market. A bit softer yesterday on the S&P 500 this morning. Equity futures slightly positive by 0.05%. If you're looking at the bond market yesterday, yields adjusted higher. Right now, Lisa, just short of 380. There we go, 380.12 on a US 10-year this morning.
And that ratcheting up in yields really seems to be a theme, especially as we are expecting to get more data showing that the economy is resilient. 8:30 a.m. initial jobless claims, they really are still pretty low, even though people are still concerned about recession and some sort of tightening or loosening, I should say, in the labor market. Curious to see whether that changes today. The Bloomberg Invest Conference does continue. Goldman Sachs' John Waldron. Nassim Taleb is going to be joining this one anchor from television.
Really looking forward to this. He's got a new book out. Scott Patterson wrote this up, and Taleb is on his game in 2023.
Very much looking forward to that interview. I believe it's later this morning around 10:30 a.m.
My people
Eastern.
haven't told me yet.
Katie Koch, also of TCW, will be speaking. And at 4:30 p.m., I think this is interesting because sort of the backdrop to the pricing out of rate cuts is a banking crisis that's over. That seems to be the theme. So at 4:30 p.m., we get both the Fed balance sheet as well as discount lending outstandings, basically emergency lending programs. Can we count the bank crisis as over as the Fed's balance sheet goes back to where it was before the crisis?
Really glad you did this, John. This is the heart of the matter. When you talk to all the strategists, they're looking at QT, QE, QTT, QEE is the tipping point of where we go into the third quarter.
Alberto Gallo sat in that chair yesterday. He said if they want to tighten monetary policy, they need to do something about the long end.
Others are Ira Jersey's talking about
Others talking about
Tony
it too.
Dwyer's not talking about
Tony Dwyer joins us now, Chief Market Strategist at Canaccord Genuity. Now, for our audience elsewhere, you might think this is going to sound like a bit of a diet, a workout regime, but it's not. It's about markets. Tony, you said light and tight. You want to be light and tight through most of this summer. Just walk me through where you are now, just positioning your approach to this market at the moment.
Well, first is working for a Canadian company. Don't blame us for everything. In addition, it's great to have you three back. So John, light and tight basically means keep a little extra cash and be a little bit more on the defensive side. And I've been hopefully very clear every time we've been on. I don't think you want to be Armageddon negative, even though economically I still expect a recession. I think, ultimately there's three stages of a market decline. There's first or a market scenario when you're in a Fed tightening cycle. First, good news is bad news because it means the Fed's going to get tight. We obviously saw that in 2022. Then you get bad news is good news because that means the Fed's going to be stopping and you get a rally, and we saw a couple of those. But ultimately, if you do go into a recession, bad news is bad news. The market goes down, and that's when you want to be poised to attack. And right now, I think there's this great hope, guys, that there's a soft landing coming. And to me, that's still the worst case scenario.
I look, Tony, at the equity markets, and you've been so good about this, saying we're not going to be cautious until we see recession. Do you see recession, and is that the cause for your caution?
It is, and it has been. So guys, I constantly hear, all right, smart guy. Well, they don't say smart guy. All right, where is this recession? You've been talking about it for the last 6 months. Ultimately, with my friends at Ned Davis, they have a great chart that shows when you look at the 6-month to 10-year U.S. Treasury yield curve, which is the widely followed yield curve, historically, there's a lead time from the initial inversion to recession of 11 months. Now, the variability is about 8 months to 21 months. The 21 months was before the great financial crisis. So think about it. We're now about 9.5 months into it. So don't you think somewhere around the 11, 12, 13, 14, 15-month mark before the great financial crisis, everybody was saying, okay, where's the recession? You've been talking about it for a while, and eventually it did come. And it always is coming from credit. And this time, you did a great job showing the QT, the balance sheet. Ultimately, bank failures or the systemic risk in banking wasn't the issue. It comes down to lending. And my issue looking for recession is where are you going to get the money? If lending standards are tight, if the financial markets are still, mixed at best, especially relative to a year ago, and you're already at full employment, where are you going to get that incremental money to have a sharp growth rate?
Right now, people are talking about positioning defensively at a time when recession may be on the table at some point, but it keeps getting pushed out. I keep wondering, what does it mean to be defensive at a time when yesterday you saw bonds sell off and you saw tech sell off because suddenly it was interest rate sensitive again?
Right, Lisa. So defensive to me is not mega cap tech stocks. It never has been. I would not have been, levered long in that space with AI. I wouldn't have. I don't think that for us, most portfolio managers, if you guys have covered a lot, you can't be long just those 8 stocks. And up until last Thursday, prior to the payroll report, you had 8 of the 11 sectors in the S&P 500 down more than 2% for the year. So sometimes we kind of do this as made for TV. What's your S&P target? But when you talk about a strong market, you have to say, okay, what market are you talking about? If you're talking about the broad market, which, by the way, is having a little bit of a rally, and we wrote a note called the Hustle or the Russell yesterday, you're getting this a little bit better rally on the hopes that you can avoid a recession. But defensive to me is healthcare, utilities, those consumer staples that'll typically hold up when you have a top line slow down economically.
Tony, how concerned are you that right now you are seeing a growing number of people go into riskier securities, go into the AI story just ahead of something that could be possibly problematic? Do you feel like people are getting lured in just before the kill?
Just before the kill is, I don't know that I'd phrase it that way, Lisa. But yes, the answer is yes. You got a VIX at 13. You got people day trading the 0 date options. Like, to me, that's just simply gambling. You've got so many different factors. And again, it's this idea of, okay, where's the recession? Maybe we're going to have the soft landing. But ultimately, we're doing nothing differently than history. Your shortest duration between an inversion and a recession is 8 months. Going back to the 1960s, we're at 9.5. The median's 11.
Tony, it's TV. What's your target on the S&P?
You know what, Tom? I stopped doing it. So here's what I'll give you. I'll give you this. And this goes into kind of the new metric of higher.
Tony, it's not a philosophy show. What's your damn target on the S&P?
I'm not going to give you one, but I'm going to give you an earnings estimate of $210 versus the street of 220. So I'm a little bit below the street.
Okay.
If you look at the current price of the S&P 500, it gives you a PE of about 20 and a half. That's too high. When you even look at the earnings yield, it's more like about 5% when you're getting almost 5.34% on the 6 months. So you don't have to make a big downside bet. You don't have to make a big upside bet. It's a very unclear environment. It's like the skyline in New York right now with wildfires. When you don't need to make a bet, I don't force it, because what happens is when I do and it looks wrong, I capitulate too quickly because I don't have a high conviction level in it. I have a high conviction we're going to go into a recession, and when we do, and if the market does respond with bad news becoming bad news, I want to be in a position to attack it, which means a little bit extra cash, but not overly defensive, not Armageddon, get only into the defensive. Be tight relative to the benchmarks with a little underweight in mega cap and a little overweight in smaller cap.
Came really close to giving us a price target then, TK.
He made us do the math.
Gave the earnings and told you what the multiple should be.
You guys are good at math, right?
210 plus, it's got an 11 multiple on it.
Tony, thank you.
Down to 2,400.
Tony Dwyer of Canaccord Genuity. Tony, appreciate it, as always. Don't worry, we are going to talk about this. Messi, we need to talk about this, not just because of the sport, but also because of the business deals here. Lionel Messi, arguably one of, if not the greatest football player ever, going down to Miami to play for David Beckham's Inter Miami. And Tom, the profit-sharing deals that we could see with Adidas and also with Apple. So we've now got this big multi-year deal for the MLS to be streamed on Apple TV, Tom, and there's going to be a profit-sharing deal with Messi and subs, according to the Athletic. That's amazing.
Quasi-owner, but basically he's going to a minor league team, right?
Yeah, not a great team at all.
Okay.
And turning down big money to do it. Turning down big money.
Couldn't
going to have that conversation a little bit later. I'm sure he could. Whether he wants to is a different story, Tom. Ed Yardeni in the next hour. The president of Yardeni Research, constructive on this equity market and why this might be the mother of all melt-ups. That conversation just around the corner. Futures just about unchanged. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Some 230 square miles of Ukraine's southern Kherson region is underwater 2 days after the destruction of the Kakhovka Dam.
A regional governor says almost a third of the flood zone, where thousands are being evacuated, is held by Ukrainian forces, while the rest is Russian-occupied territory. Now, Kyiv is assessing the humanitarian, economic, and ecological damage of the disaster that Western leaders denounced as a war crime. Bloomberg has learned a mood of deepening gloom is gripping Russia's elite about prospects for President Vladimir Putin's war in Ukraine. Sources say many within the political and business elite are tired of the war and want it to stop, though they doubt Putin will halt the fighting. President Biden has vetoed a bill initiated by congressional Republicans that was designed to repeal the administration's student debt cancellation plan. Now, Biden's executive action would forgive up to $20,000 in federal student loans for some borrowers. But the battle is far from over, as his plan still faces justices in the Supreme Court. And apartments in Manhattan are being snapped up at the fastest pace in nearly a year, just ahead of the busy summer season. Appraiser Miller Samuel and brokerage Douglas Elliman Real Estate say units were listed for an average of 35 days, down from 48 days in April and 52 a year earlier. This despite the higher cost for rent. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
What we need to do now is figure out how do we make sure that that relationship is strong to deal with the challenges of the future. I know that's what we're going to be talking about, but particularly strengthening our economies. And that's what it's all about.
It's important. You know, what was it, like 81 years ago, another prime minister, Winston Churchill, came here and we'd have him speak in Congress. And, I think we'll just build on what he talked about too.
Yeah, it's a great foundation for us to cooperate on. So no, it's great to be here. Thanks for having me.
The British Prime Minister Rishi Sunak and the House Speaker Kevin McCarthy in Washington. The Prime Minister visiting Washington, D.C. I understand seeing the President as well. Might build on that a little bit later, or maybe
that was McCarthy's best meeting yesterday.
That was it.
That was it. Emery Horder's going to be along on a truly historic
felt a little bit contrived, that, didn't it?
You think?
That odd exchange
when in
between
doubt,
the two of them.
Mention
Churchill and just be like,
yes.
talk about winging it, right? Mention Churchill. I guess we'll just build on that. whatever he said 81 years ago.
It did feel like, okay, I say nice thing, you say nice thing. We're doing well right here. Yeah, okay.
You're sort of leaning towards the PRs to scream at the press to get out. Everyone get out. Clear out, get out. Okay, if you're just tuning in, welcome to the programme. Let's whip through the price action on the S&P 500, slightly positive. Lita went through the data for the day ahead. Jobless claims coming up in about 2 hours and 10 minutes' time. Look out for that. So far, the labour market looking okay, depending on what labour market data you look at. If you look at the payrolls survey out on Friday, things look pretty decent. You look at the household survey and the unemployment rate, and things are starting to crack, maybe. We'll see what claims bring in a couple of hours' time. Yesterday, yields higher. Today, just a little bit, back at 380 on a US 10-year. The Bank of Canada with the latest surprise, following the central bank out of Australia with a surprise rate hike this week as well. And Tom, just reintroducing some of the risk around next week, maybe. Andrew Hoddenhorst and the team at Citi, economists there, calling correctly that Canada would hike interest rates yesterday, still calling for a hike of 25 basis points next week from the Fed.
They've been dead on. And again, it goes to data dependency. Why are they going to decide now about what they're going to do June, whatever? They're going to wait for the inflation data, wait for other data as well, including, frankly, claims and the dynamics here in 2 hours' time.
CPI Tuesday. That's the next hurdle. You're right.
And I just think we're data dependent here with futures up 3 right now. The 10-year yield we're all watching, 3.80%. Imagine a 4% 10-year. Right now on Ukraine, and she has been so dead on. Tina Fordham on the tragedy of Ukraine, founder and geopolitical strategist, Fordham Global Insight. Could you imagine a dam breaking and the damage to Kherson in southern Ukraine? Did you see that coming, Tina Fordham?
Well, we know that these kinds of tactics are pretty consistent with Russia's kind of scorched earth MO. And in fact, the Ukrainians told us that the Russians had mined the dam. And so we should have been prepared for something like this. We're in a very critical phase as we are in late spring with Ukraine's offensive, much anticipated. They keep denying or kind of hushing up when it's happening. This is really consistent with what Clausewitz called the fog of war. And that's very much where we are at this stage in the conflict.
How does this event change, I guess, the state of Ukraine and the war, and particularly the relationship of Ukraine to their allies?
Well, it's a setback, although, of course, the Ukrainian Defense Ministry and President Zelensky are soft-pedaling that. I mean, Ukrainians' morale remains remarkably high, troop morale and citizens. They're evacuating people. They'll deal with the humanitarian consequences. But you've seen, for example, that the water supply from the Kakhovka Dam is important, according to the IAEA, for cooling the Zaporizhia nuclear plant, which is something that I've been talking about, kind of below threshold actions that would constitute an escalation. And this is what investors are watching for, of course. Is the war escalating in a meaningful way where there might be spillover? Certainly the risk temperature now is much higher, but let's also bear in mind that Ukraine, in terms of its military preparedness, is in a much stronger position than it was this time a year ago. It's got the Leopard tanks, it's got the Abrams tanks. In fact, apparently the first NATO-supplied tanks seen on the battlefield were French. So they are trained now in offensive maneuvers, but the pressure on this, the success of this offensive is extremely high. There's no question about it. The patience is running out, although the show of strength in terms of support for Ukraine at the G7, it remains very high, I think, defying a lot of international observers. But there's no doubt in my mind that everybody wants to see Ukraine gain leverage.
Tina, a lot of the focus right now is on the alliances, and that's the reason why perhaps some people, not us obviously, are focusing on Rishi Sunak down in Washington, D.C. I am wondering if you do think that is of interest in any way, that sort of plain vanilla conversation that we just heard of sort of vaguely self-congratulatory back and forth.
Apart from being so cringy. I mean,
but just in general, is there anything you're expecting to hear from this confab down in Washington, D.C. with Rishi Sunak?
For sure, they'll announce a show of unity and strength on Ukraine, and they will announce plans to continue arming and training Ukraine. That is a given. What Rishi Sunak, the UK Prime Minister, is not going to get is the digital trade deal slash, rare minerals, narrow trade deal that he's hoping for. Remember, he's a Prime Minister of a government that's 20 points behind in the polls. And the UK has elections next year, as well as the United States. So he's a prime minister in a weak position. And the relationship is frankly less of a strategic priority for Washington than when the UK was one of the most important members of the European Union and had a lot of other fellow free trade Atlanticist powers standing alongside it. So I think Sunak will be disappointed, but he'll still come away with something to show for his visit to DC.
How does that characterization of the UK stand up to the need for UK military support in places like Europe, the mainland, and the situation with Ukraine?
So this is really important, and I think I want to emphasize it for your international audience. Even if there is a Labour government next year, and I'm not making that call, despite the very pronounced lead in the polls. A lot can happen, as we know. You're not going to see a change away from the UK stance in support of Ukraine. Of this, we can depend.
Tina Fordham, Fordham Global Foresight. Tina, thank you on the latest, the visit from Rishi Sunak, the Prime Minister, down in Washington, D.C. Got a ton to talk about this morning. Tom, you mentioned we're going to catch up with a meteorologist a little bit later about the smog, the weather in New York City. Need to catch up on the sport as well. This PGA Live tie-up and this amazing deal.
It's bigger today than it was yesterday.
This amazing deal secured by Lionel Messi and Major League Soccer in the United States. Truly setting some amazing precedents here. Tom, I was trying to describe to you in the commercial break what this could look like in, say, Major League Baseball. Can you imagine, let's say, and I know the network situation and televising Major League Baseball is a mess, but let's say there was one network and let's say it's ESPN, and ESPN came up with some kind of profit-sharing deal with Aaron Judge, which essentially was subsidizing the payroll of the New York Yankees. How do you think the other franchises would feel about that? It's truly amazing to see something like this develop.
Yeah, Craig Moffitt and Michael Nathanson, I think, among others, have been way out front on this. And what it is about desperation. And I think certainly PGA Live goes directly into that. It's a desperation here of the old days are over, the captured audience is over, and what do? And to do that, you have to co-opt the players, as you mentioned with Mr. Messi. I mean, it's clearly where
tried it with Pele back in the 70s, right? Tried it with Beckham.
5 years ago, what would Brady have negotiated?
What, with the network?
Yeah, per game fee, profit taking off.
The issue is that I think there's a decent argument to make that a player that good with that status just has this transformative impact on a franchise, just the sporting world in this country, in a way that a single player in baseball or American football does not.
I don't know. I just got a message here from Tottenham, and they said, really, went to Miami.
Spurs were in the race.
Spurs was on the short list. Yeah, absolutely.
Alex Webb's going to join us a little bit later to have a proper conversation about this. I'm looking forward to that. Jeff Yu of BNY Mellon joining us shortly on the equity market and beyond. Stocks right now just about positive from New York. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From the Wizards and Capitals to new ventures and innovative investment, running a sports empire in Washington, D.C. is a monumental task. Owner Ted Leonsis trusts CFO Peter Bichet to execute monumental sports and entertainment's financial game plan.
We are definitely in growth mode. What else can we do? How do we grow the platform?
Watch Chief Future Officer, Wednesday on Bloomberg.
Lots of messages from East London this morning. Why aren't you talking about West Ham? Well, congratulations, West Ham. I just didn't want to explain to Tom what the Conference League was, and I have no interest spending any time doing that this morning. But congratulations, West Ham. Jeff, you alongside me laughing because he knows where I'm going with this. I'm not going anywhere with this. Your equity market on the S&P 500, just about positive on the S&P this morning. Positive this morning, a lift. Yesterday, the NASDAQ 100, a drop, a big drop. Biggest one-day drop going back to late April. We were down about 1.8% yesterday. Finally, apparently, bond market moves do matter to the tech stock rally story. The 2-year this morning, 456.51, yields up a little bit, up a lot yesterday, off the back of a surprise rate hike from the central bank in Canada, following another surprise earlier this week from the Central Bank of Australia, and raising a question as to whether we might get some surprises in the Fed's future as well. Bear in mind that only at the start of this year, the Bank of Canada was communicating a conditional pause. Does that sound familiar? Is that what we'll get from the Federal Reserve next Wednesday?
Is there such a thing as a conditional skip?
A conditional skip? A conditional
That's
pause?
how silly this is. I like the Bank of Canada.
They're going to spend 24 hours talking about this. Are we sufficiently restrictive? You can wait and
I'm all
find
Bank
out.
of Canada on this.
Do you think surprise? Just go for it.
Just make an announcement.
Just make an announcement and move on.
Yep.
Do you have the luxury of doing that if you're the Federal Reserve?
Not in the communicative strategy of this year.
I'm going to offend Canada again this morning. Forgive
You're doing
me.
good.
Second-tier central bank. It's a second-tier central bank. Okay? When you're a second-tier central bank, you have the luxury of delivering surprises. I don't think you have the same luxury if you're the chairman of the Federal Reserve, for that matter.
We'll probably hear from Mr. Trudeau today, not only on central banking, but also on fires that have gripped the nation, and particularly the Northeast. We are thrilled to bring you our Senior Vice President, Lack of Hysteria. Rob Caroland has done weather for Bloomberg Surveillance since time began and joins us on radio and television. Rob, thank you for taking time out in a crushing schedule. When do the smoke, when does the fumes, when does it all move on?
It's going to move on this weekend, Tom. There's going to be a change in the flow pattern. Right now, we're in a stagnant pattern with an upper level low over the Northeast, but by the weekend, that system breaks down and moves out, and we should see a bit of an improvement.
Rob, how does this compare to the rest of the world, what we're going through right now in New York City, in the tri-state area?
New York City had the worst air quality in the world, both yesterday and the day before, Jonathan. Off the scale for particulate matter floating through the atmosphere in New York yesterday and the day before.
Rob, it's just amazing. Have you ever seen anything like this in your career?
No. You got to go back to May 19th of 1780 to have anything of any precedence in the Northeast. That was called the Dark Day in New England. Wildfire smoke caused people to have to use candles at noon from Portland, Maine, all the way to New Jersey on that date in 1780. So it's been a long time since we've seen something like this.
Do you have any ability, Rob, one final question here before we move on. Do you have any ability to say this will be repeated through the summer? When you look at Canadian weather people and all about the fires, can this happen again?
It could happen again, Tom. My hope is that this next upper level low that moves in Monday through Wednesday is going to bring some rain eventually to parts of Quebec and Ontario and maybe help reduce some of those fires that are currently taking place.
Hey, Rob, it's been too long. It's wonderful to get your perspective on things. Rob Carradine there of Hometown Forecast Services. TK, some seriously crazy smog in New York City, like real pollution. Waking up this morning, coming to work, you can smell it.
Oh, yeah.
You can you can smell it.
And I noticed the dogs, vet bill and kennels, are just mental. Yeah, it's definitely there. We should point out the airlines, I don't have an update right now, but incoming flights, the last I heard, to LaGuardia and Newark were challenged, to say the least.
I saw some delays yesterday, particularly LaGuardia, for obvious reasons.
More on that as we start up the day. Let's continue on now, and we do so with Jeffrey Yu visiting with Paul Sweeney yesterday at his BNY Mellon conference in Florida, and has jetted up to join us. He is Senior Market Strategist, BNY Mellon. It's a quiet period, but it's not a quiet period. I'm going to ask you an open question to start. Equities, bonds, currencies, commodities, where is your single focus now into the Fed meeting?
I think the single focus is we need to acknowledge higher for longer. My single focus is those residual Fed cuts that still seem to be the market is intent on pricing and heading into next January. Probably needs to get rid of them. Yeah.
We talked about the fog as being sort of a metaphor right now for a lot of the uncertainty that we have in the market. It's unfortunate and convenient. However, I do wonder how much this lack of conviction makes you have all that much more conviction in cash. Because if you could just sit there and earn something, even if you're not blowing it out of the water, it's better than nothing.
That's been the theme that we've observed in our flows for the best part of the last 6 months, if not longer. But having said that, there is one new dynamic seemingly coming through. Things are flatlined, so people are not adding to more cash because they're seeing that allocations are just so low right now to risk, and the institutional investors that we custody for, I think they're starting to push some funds in, not speculatively or opportunistically, but they're looking at valuations and they're looking at the growth environment. It could be a bit more benign than we give it credit for, so funds are actually being pushed back in.
In the next half hour, we're going to be speaking with Ed Yardeni, who's going to talk about the mother of all melt-ups, MAMU, as he calls it. And I'm wondering how much this positioning right now of an increasing amount of cash is actually being fuel for this mother of all melt-ups that could be coming.
I think it is going to be the fundamental asset allocation story for the second half of the year. But on top of that, the macro picture is, can we dare to envisage maybe a soft landing again? I was having a few conversations around this. If we can get to, say, year-end with still payrolls around 200,000, 250,000, but core inflation, core PC on the way down to 4.5%, I think that is a good environment. That's a good result. So if that translates into the corporate profitability, stability, and earnings growth as well, then with the cash on the sidelines, your better return profile, why not push cash back into equities?
I feel like right now there's two different views. Either you just sit in cash, take 5, or you go to AI and chase hopes and dreams. Right. Is there something in between right now for you?
It's that barbell story as well. If there's still one asset class I have conviction on globally, I think it's emerging market assets. A lot of interest in LATAM right now. They're benefiting from a US story is still positive. I do think a China stimulus is coming as well on the commodity side, and see credibility in that region in terms of positive real rates. We always go back to the real rate story. The Fed is giving you a 1% or so real rate buffer, but in LATAM, they're giving you 2, 3, if not higher. So in terms of asset allocation, the residual flow, I think a lot can go there too.
China stimulus, what are you expecting?
So if we use the benchmark from years ago where they had that tax cut round as around 2 trillion renminbi mark, that is the baseline, like the bare minimum to really make a difference to the data. But on top of that, I think there needs to be a shift in expectations. When I was there for the first time in many, many years, a few months ago, there was just this palpable fear that things could still go back to where they were a few months ago. But that clearly is not the case right now. So there's got to be a governmental push, but again, encouraging the private sector that they can leverage, they can add to their balance sheets and move on accordingly. Because China's been de-risking, de-leveraging over the last 2 years.
To China, and it's the last 24 hours has been just extraordinary. How do you treat the IMF's cautious 5-year view, even what OEC did yesterday? Do you just instantly say, I want to be suspect of that and take a contrarian, more optimistic view on global GDP?
Well, I think global GDP is reflective of where global productivity is, where global demographics are. China's own growth forecast, if we go back to March, when they came out with the growth targets to the MPC, that was considered conservative at the time, especially if we take into account the rebound and the rebalancing coming through. But then if that is a warning signal, then I think it gives the impetus for governments to spend, to invest, to boost productivity, to boost growth and get things back on track.
Leland Miller at China Beige Book is heated that the street has this wrong. He's far more optimistic of the domestic Chinese experience and says it will even come over to a Pacific Rim statement. is this the mother of all opportunities we're missing?
I wouldn't say it's the mother of all opportunities, but given the last 3 years, China's almost been an afterthought in terms of asset allocation because of lockdown, because of other factors. There is an opportunity set there as well. But having said that, going to the fiscal story, that's also one thing I deeply worry about globally right now. When the IMF with Chancellor Hunt just upgraded ports for the UK, one thing Georgieva said was, please don't do additional fiscal stimulus right now. We've seen what happened in Turkey before the elections. We've seen what's happening in Poland right now. New Zealand, for example, pushing through stimulus. That's the last thing central banks need right now. To be honest, even the debt ceiling debate, maybe the fiscal consolidation, shall we say, was barely anything. So central banks, they need some help from the governments.
That was the most diplomatic way of saying they actually didn't make any progress in cutting any kind of spending whatsoever in the debt ceiling debate. Just sort of putting this all together, this is a time of mid-year reviews.
Yes.
And there were a number of high conviction trades in the first half that were absolutely demolished, annihilated. What are some of the conviction trades heading into the second half that you're concerned about? And I think about the conviction trades that you talked about of AI and long cash.
Right. So in terms of AI, do we want to think that is that you do have the growth story, you have the innovation story, but is there a TINA focus in there again? And I do have some cash allocations to push for. I will just go with the TINA theme. So I think that is one thing to bear in mind. But going back to my earlier point about Fed cuts need to be priced out, one conviction view that we have is this higher for longer narrative globally, and we're talking about potentially no cuts from major central banks at all until at least the second half of next year. Whereas that is not something that's priced in, I would say, the Fed or anywhere globally, because it's sticky inflation, persistent inflation, and fiscal is only going to make that worse. And we've got quite a few elections coming up globally over the next 18 months as well, and we love electoral giveaways on the fiscal side, don't we? So that's where curve steepening, bond yields. Will we even be looking at, say, JGB 10 years at 1.5%? These themes are going to come through.
Hey, Jeff, that's interesting. Jeff, you there of BNY Mellon, looking forward to 18 months of politics and financial market volatility, potentially, TK. It's amazing to see the technocrats and the central bankers warn about fiscal stimulus. You hear it from the ECB as well. They're uncomfortable with the nature of fiscal support for paying energy bills now that energy is priced lower.
So my takeaway is, Jeff, you on the edge of Bullard. I mean, this is important what Jeff, you just said here about not extending out the rate cut derby now, but getting out into the second half of next year.
Of 2024.
Yeah, that's a big deal.
To Lisa's point, and we've been talking about this for weeks now in this program, we've just spent 6 months beating up on consensus positions. Coming into 2023, no one liked tech ripped. Coming into 2023, it was about rate cuts, had to price them out. 2023, it was about short the dollar, then the dollar started to strengthen. Long Europe, long China, Europe. Technically, can I call that a recession in Europe now, Jeff, with that revised data?
I think
can I call it that?
The ECB would beg to differ for now, but let's see what the forecasts are in a week's time.
2 quarters of negative growth in Europe after the revised data. Q4, Q1. China, think about the China conversation. We've gone from reopening boom to China needs stimulus in 6 months.
The big fear that I have is that you get sort of a battle between central bankers and the fiscal policymakers, especially with these election cycles. If they keep coming out and saying, we have to keep spending to keep the population okay, and then central banks have to respond.
The point that Jeff is making, ultimately, Tom, it can lead to high yields, steeper curves.
Or longer. The key thing
into
is
next year.
Longer, the time frame. Yeah.
Jeff, great to see you, buddy.
Likewise.
Just fantastic. I've missed you. It's good to see you in person. Equities just about positive on the S&P 500 from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The mayor of New York has told residents to stay indoors or wear N95 masks if they go outside, as the most polluted air in decades blankets the region. And this as wildfires continue to ravage large tracts of forests in Canada, sending smoke more than 1,000 miles southwards. Prime Minister Justin Trudeau says it's the worst wildfire season in Canada's recorded history. House Speaker Kevin McCarthy called off votes for the remainder of the week and sent lawmakers home. A revolt by Republican hardliners halted business in the chamber for a second day. The blockade by a band of 11 ultra-conservatives heightened tensions among Republicans following the Speaker's backing of a compromise with the White House to avert a U.S. debt default. The Speaker says he was blindsided by the revolt. Coinbase CEO Brian Armstrong says the SEC started to change its tone in its questioning of the company last year before filing the lawsuit against the crypto exchange. He told Bloomberg that the firm had been forthcoming with discussions, but was unfortunately met with silence.
This was not unexpected. We've been in discussion with the SEC for a long, long time. Even going back to before we were a public company, we started sharing with them how we operate our business, how we list assets on the platform, how we think about our staking program. And through a large number of dialogues back and forth, they allowed us to become a public company. We had many discussions with them in the last year when their tone started to change.
This week, the SEC has widened its crackdown on crypto and has accused Coinbase of running an illegal exchange. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg. Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The AIs have sort of dominated the long portfolio for 5 or 6 months. If it's as big as I think it is, NVIDIA is something we're going to want to own for at least 2 or 3 years, not for 10 months, and maybe longer.
Just an absolute clinic from famed legendary investor Stanley Druckenmiller there, not just on AI, but Tommy talked about long short, how he likes to play short because he enjoys it, but ultimately that's not where the money's made.
I rarely say this, but I want you to sit, folks, on the digital replay of this a good 20, 30, 40 minutes with Mr. Druckenmiller. And there's some interesting stuff in it and tangential political stuff and all that. He is absolutely brilliant on the mathematics of shorting, much like what I'm going to talk to Taleb about today. It is a required listen for anybody young on Wall Street about the entertainment of shorting versus actually not losing money at shorting.
Well, that's the point. He said, you go long, you can lose 100%. You go short, Tom, you can lose a whole lot more.
Jim Chanos would say the same thing, but there's some real high points within this conversation. Because of time, we're going to move on. Rishi Jaluria with us. He's with RBC Capital Markets, and all you need to know is Microsoft. He's truly expert on this. Rishi, I want to get away from all the blather on AI, ChatGPT. I'm hearing some real authenticity about ChatGPT. What's it mean on the income statement for Microsoft 5 years out? Which margin line are you focused on, and what will be the delta of improvement due to AI?
Yeah, and thanks so much for having me. Look, when it comes down to how this flows through to the P&L, the great thing with Microsoft is there's many different ways that they win, right? It shows up on Azure because of the commercial arrangement with OpenAI, helps on their entire product portfolio. Now you bring an interesting point because I think there's the whole back end, and by utilizing generative AI themselves, you get all sorts of savings on R&D with significantly higher developer productivity, better sales and go-to-market, even some G&A leverage. But the one line it actually hits in a potentially negative way is on the COGS line, right, and your gross margin, if you're looking at it purely on a margin perspective, because the amount of storage and compute resources necessary for generative AI are significantly higher than what we see with traditional cloud workloads. However, there's also a dollar uplift. So if we're looking at this on purely an EPS or a dollar net income basis, all of this is accretive because there's so much more that Microsoft can charge for these generative AI-enabled workloads or any sort of technology that's embedded throughout the portfolio that utilizes generative AI. So this should all be accretive to EPS in the long term, even if it means a gross margin hit over the long term.
I get the idea there may be a revenue pop at the top line of the income statement, but if I got 68 cents in the dollar gross margin, 48 cents in the dollar EBITDA, what are those dynamics 3 or 5 years out? Have you been able to quantify that yet with all the hoopla?
It's still very early to be able to tell that. I will say our own models, the way we've kind of been thinking about this is remember, when we went from an on-premise world, we went from 90% gross margins to 75% gross margins, which is your average SaaS company. In reality, we may see a move from 75% gross margins to 60% gross margins across the board, but there's also this big, 2x to 3x uplift we saw from going on-premise to cloud, and I think we could see that similar uplift. So even if the margins end up actually being lower, although I think EBITDA margins may end up being flat at the end of the day, your overall gross profit dollars, your overall EBITDA dollars will actually end up going up a lot as a result of generative AI.
One thing that's sort of a distinguishing feature between the cloud, which is all sort of in the ether and sort of runs on energy, and that's sort of the physical reality of it, versus generative AI and ChatGPT is the physicality that we haven't yet imagined. What are some of the application use cases? And I think about, for example, the goggles that we just saw from Apple and how that might be the future of computers, of the personal computer. What are you envisioning in terms of the archetype of what we should be looking for to understand the companies that are going to benefit both on the hardware of it as well as the software?
Yeah, absolutely. And look, I think whatever use cases we can imagine for generative AI, especially as it relates to enterprise software, those are going to be very different 3 to 5 years from now versus what we're seeing today. So, we can only kind of scratch the surface of what's actually going to happen. But I think the bigger thing we have to take a look at when it comes to enterprise software is, you talked about virtual reality as being potentially the future of computing, and that's entirely a possibility. I think generative AI is going to be the primary way in which we interact with software over the next 5 years, right? It may take time for that to shift. We all remember what happened when we went from the command line interface to GUI, right? When we went from Microsoft DOS to Windows. And I think we're going to see that similar shift. And so when we want to say who's really going to be a beneficiary of this, right? It is absolutely, Microsoft. I think that not only has software solutions that benefit from this, like GitHub Copilot, like OpenAI services on Azure, Office 365, but they also provide the technology that enables others to embrace generative AI, right? Especially on the Azure side of the equation, along with some of the hardware. You see that they're working on potentially building out a rival to NVIDIA's GPUs, just given how much demand there's going to be. It's hard for me to not see Microsoft as being a beneficiary of this in a big way that I still think is not even priced into the stock today. Now, if we want to go and say who else in enterprise software can benefit from this, I really think it's the large platform vendors that have a lot of data, have a lot of history with their customers, and have the use cases kind of already sketched out and seem to be moving fast. I would think about companies like Salesforce, companies like HubSpot, companies like MongoDB, that have that roadmap, but also have that touch points with the customers and their customer data that can really supercharge the way in which customers get value out of their platforms.
Rishi, you're talking about how you see why there's a buying opportunity. How do you even start to put valuation figures around some of these names? Do you just buy first and ask later about how this translates into some sort of market valuation?
I think that would be a trap if we did that. So fortunately, we're not doing that. We are absolutely trying to figure out how to quantify revenue uplift and ultimately, net income or free cash flow uplift, because profitability does actually matter at the end of the day. It's not just growth for the sake of growth. And so what we try to think about is a couple of things. What can this drive in terms of additional monetization and uplift in terms of what you can collect from customers? What can this lead to in terms of competitive displacements? Where can we get some additional efficiencies on throughout the P&L that leads to additional profitability? And think about all of those sort of things, and that really quantifies what is the ultimate free cash flow uplift at the end of the day, and how does that plug into our DCF models? So absolutely, we try to quantify it. It may be too early, it may be a little bit, but I think we have to have that framework. Otherwise, if we're just buying something on AI hype, then we end up with situations like companies like Palantir that aren't actually even doing AI, and the stock has doubled over the past month just on hype, but not even figuring out how does this plug into your model.
Rishi, great to catch up. Rishi Jaluri there of RBC on the distinction between hype and actually making this happen. NVIDIA, that stock is up by 156% year to date. If you are just tuning in, plenty of disruptions to flights in the last 24 hours connected to the wildfires in Canada and the smog that we've seen come down through the United States, particularly here on the East Coast in the last couple of days. This from the FAA, inbound flights to LaGuardia grounded on low visibility. That headline just coming in. Inbound flights, Tom, to LaGuardia grounded on low visibility.
For those in the Northeast, and particularly on Bloomberg Radio, to the south is worse. There's no other way to put it. Central, southern New Jersey, and down to Philadelphia, where the numbers are truly unimaginable. There's different ways you measure this, but basically, New York City is unhealthy, and Philadelphia is hazardous. That's the sort of the language the pros use.
So if you are planning to fly this morning, expect perhaps some disruptions. The latest headline just coming in, Lisa. Inbound flights to LaGuardia grounded on low visibility.
And I believe the reports are that it's going to get potentially worse again throughout the day. Remember
Is that the
yesterday
report? I hadn't seen
when
that.
it was, and then it will get better.
You nailed it yesterday.
As it sort of fades away. I will just say that the emotional impact, especially you talk about your dogs, on kids, on other people, people who have already lived through the pandemic, is pretty significant.
We had a school event canceled. The Yankees canceled baseball.
Yeah.
Philadelphia Phillies, I believe, canceled baseball.
You emotional about the baseball cancellations?
No. The dreaded Yankees didn't play. That's always a good thing. But, the headmaster of the school sent a lovely note just saying, we can't do this. They're going to have a street thing or something.
Are the kids happy with that?
The kids don't care.
I was the kind of kid who would have been happy
they're so
with
on
that.
to summer.
I'd have been thrilled by that. Cancellations, love that stuff.
Do you have homework? Yes. You're going to do it? No. Okay, great.
Clearly, move on. That's the way it works at school, isn't it?
I feel it in the top of my mouth. I'm definitely.
You can taste it.
Can taste it. Yeah.
I'm here. I hear you.
Tang is not helping us.
No, I doubt it. Ed Jardini, if you had any research coming up shortly, he's constructive on this equity market. We'll get to an equity market bull in just a moment. Your equity market right now going absolutely nowhere. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
I absolutely think that growth is going to slow from here.
You have, we believe, a slowdown coming, potentially recession.
Inflation, it's coming down, but it's going to remain elevated.
The reality is there's just a lot less upside left in this rally and potentially meaningful downside.
We do think something else will break between now and year end.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The smoke-related disruptions continue this morning from New York City. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market just about unchanged on the S&P 500. The latest news in the last 10 minutes or so, the FAA saying that inbound flights to LaGuardia have been grounded on low visibility. Saw a little bit of this yesterday. The FAA slowing flight traffic into some NYC airports, Tom. Saw that in the last 24 hours. Understand that Philadelphia International Airport, similar story.
Philadelphia, I'm going to suggest worse. Washington, a little bit better. We've got Ed Yardeni coming up. He's 40 miles outside of New York. He's in better shape than we are. It's very variable, not zip code to zip code. That's too narrow, but almost county to county. There's a real variability here. It's not just like a malaise.
I've not got more to say.
No, that's my weather thing. I'm tossing back to you so you can give us a 5-day. So you can give us a 5-day forecast.
I was going to say it's just been phenomenal to experience. Phenomenal. You step outside, the eyes are burning. You can taste it in the air. Elisa, we've seen the last couple of days. These wildfires just paint the sky orange here in New York and beyond.
It just feels like yet another sort of global crisis hitting the New York City area. And I say this as a native New Yorker. It's just one of those moments where suddenly there's sort of an eerie calm. There's a silence. People aren't exercising outside. People are all wearing masks again. Things slow down. And I think that that's kind of a visceral response in addition to burning nostrils in the back of your head.
I have a new respect for Delhi. Quick story. I'm in Shanghai. I got to go.
They live this every day.
I got to go. Yeah, I go 70 miles outside of Shanghai to a town I can't pronounce. And cash flow. I go, what's the town like? And he goes, it's one of China's 14 Pittsburghs. And it's a manufacturing place in that. And in the hotel room, fancy hotel, they had one of the gas masks the weather people in New York are showing right now with the things out to the side. And I've got a new respect here for what Shanghai lives every day with a rating of 80 or 90 or 100, or Delhi at 160, and this morning New York at 223, and Philly worse than that.
Hopefully in a couple of days this will pass. That's the latest. If you are just tuning in, the FAA saying inbound flights to LaGuardia Airport grounded on so-called low visibility. Just look outside the window right now in New York City and you can see the lack of visibility. Let's get to the broader equity market price action on the S&P 500. Just slightly negative on the S&P, just a touch lower, softer. Yields a bit higher, a whole lot higher yesterday, higher by a single basis point this morning. Lisa, 380.89 on a US 10-year.
That really is the theme for me, especially as we look around the world at global yields generally rising in response to a 1-2 punch from the Bank of Australia and the Bank of Canada, the Reserve Bank of Australia. 8:30 a.m. initial jobless claims. Very much curious to see whether we do see a material tick up. If we don't, how much do people start to price in an active Fed next week, that they still are potentially going to raise rates despite the skip, jump, whatever you want to call it, talk. Today, the Bloomberg Invest Conference continues. Our own Tom Keene will be speaking with Nassim Taleb, probably around 10:30, 10:35 a.m. Eastern. Don't miss that. Goldman Sachs' John Waldron, as well as Katie Koch of TCW. And at 4:30 p.m., a lot of the rate hike discussion really centers around how much the banking crisis is over. Very curious to see that in the data that comes out at 4:30 p.m. with respect to discount lending, as well as just generally with respect to the balance sheet that's come in.
Want to watch a little bit later on this afternoon. Lisa, thank you. Ed Yardeni joining us now, the president of Yardeni Research. Ed, I've loved the notes over the last couple of weeks. The mother of all melt-ups. Ed, are we closer to a melt-up than a melt-down?
Well, I think we've definitely had a melt up in the mega cap 8 stocks, as you've been highlighting. These stocks have kind of taken over the market in recent weeks. I think it really started with the banking crisis, right? In March 8th or so, when we started having the banking crisis, the financials took a dive. Even energy took a dive on fears that if the financials are going down, that can't be good for the economy. And the energy stocks went down. But people still wanted to be in the market, and they ran into the mega cap 8 because they have cash flow, and they have good business. I think the market's actually going to broaden out back to the financials. Right now, we've got some uncertainty, concerns about whether there might be another rate hike, but I think the economic outlook is still pretty good. And I think once people get more comfortable with the financials, I think the market will broaden out in that direction.
Ed, I want to give a look back here quickly in a victory lap for you. You've had a set of victory laps over a lengthy career. In October, Ralph Ancampora and Edward Yardeni said, climb on board this bottom in the market. You're up 19% from your October low. Right. The triple leveraged Yardeni fund, this is something in develop right now, is a 57% return since October. Okay, yeah, that's before Yardeni takes out his 2 and 20. But the answer here, Yardeni, I want you to talk to people who missed it. They didn't listen to Ralph Ancampora. They didn't listen to Ben Laidler. They didn't listen to Ed Yardeni. Talk to the people who missed this rally, how they get on board.
Well, I'm still optimistic that the market is going to move higher by the end of the year into next year. I think next year is sort of the environment that the market is increasingly thinking about discounting. And I think the economy is going to be better. I think earnings are going to be better. However, we have had a heck of a move, and it's been in these large cap stocks. I think, as I said, look for where there's been laggards, and there certainly have been laggards in the financial, there have been laggards in energy, even in industrials. In addition to the melt-up scenario, I've for mega caps, I've also been monitoring the situation for construction in the United States, and it's absolutely booming for non-residential construction, and I think it's about to boom for infrastructure spending. And so I think the industrials are another place to be.
You were saying that the 4,600 target that you currently have might be conservative if this all bears out. What do you say to those who push back and say, if that comes to pass and all of the people who are in cash decide it is the time to throw in the towel and go into equities, that will give the Fed more ammunition to hike rates further and kill this off more quickly?
Well, I think the Federal Reserve officials have been saying for quite some time that they want to get the interest rate, the Fed funds rate, up to a restrictive level. I think 5.25% is proving to be restrictive. There has been a banking crisis. We have seen surveys of loan officers saying that they are tightening lending standards. So I think they're where they wanted to be. And I think they have to factor in that quantitative tightening, as well as the tightening of lending standards, probably amounts to at least another 50, 100 basis points in effective federal funds rate hikes. So if the funds rate now is 5.25%, I think effectively it's already at 6.25%.
But if that's not enough, Ed, to slow any kind of growth, and you are seeing construction companies actually seeing a boom, you're seeing the housing market reignite, you're seeing all shoots of possibly some sort of recovery in manufacturing sectors that have been beaten up, doesn't this go against the idea that it is enough, that it is restrictive enough to bring about a decline in inflation to the degree that the Fed would like?
Well, inflation has been coming down, as you know. Maybe it's not coming down as rapidly as some people think, but I think it's proven to be quite transitory in durable goods and even non-durable goods. Where we still have stickiness or persistence is in services. And we know that rent inflation in the real world has come down pretty dramatically, and that's likely to mean that we get down to something like 3 to 4% inflation by the end of this year. Right now, we're about 4 to 5%. So I'm optimistic that inflation can come down very well on its own without any more restriction. I think a lot of the inflation was pandemic related. It was a shock. Have been aftershocks, and I think we're sort of normalizing.
Giordani, you talk about a broadening market. Help me with packaged goods. Some of them are trading at 19, 20, 21 times earnings. Am I supposed to acquire new shares in those companies? I mean, I'm just dazzled by the idea of buying new shares at a 21 multiple that's got a low single digit revenue growth.
You know, the bears have been certainly right about the fact that we have really never seen a situation where a bull market got started with multiples basically at fair value. The forward PE. The forward PE of the S&P 500 was 15.1 on October 12th when the market bottomed. And that is troubling to a lot of people. But the reality is if you take out the mega cap 8, which are unusual stocks, you get a multiple of about 16. So again, it's closer to fair value. Whereas with them, you're at 18 and a half. So I think you have to really kind of slice and dice the stock market and look for where the value is right now. And as I said, it's beaten up financials that seem to be pretty good values. Industrials, I don't think, have discounted what we're seeing with onshoring and with building chip plants in the United States, electric vehicle battery plants, and so on. So I think there are still opportunities in the market.
Great to catch up, Ed. What a call. Just to be constructive so far through this year. Remains constructive. Ed Yardeni of Yardeni Research, talking up the financials. Check out the post-SVB low, what we've done on the NASDAQ, on the S&P 500. On the NASDAQ from the post-SVB low, NASDAQ 100, 20% gains. On the S&P 500, 10%
What have the banks
gains.
done? You follow it more than I do, but have the banks really, the regionals, have they really
still
broken
a struggle.
out?
No,
still a struggle.
Still a struggle. It's been a struggle.
Yeah.
There's a lot of people, Tom, who just think that at the moment they're going to struggle because the headwinds around profitability are going to be difficult for the time being.
To the weather, 30 minutes ago, the Washington Post Weather Service says Washington is worse than yesterday. That's their language. And they also note to the northeast, to Baltimore and up to Philadelphia is hazardous, just for those driving, traveling, and thinking of moving today.
Do you want a big story? This from the Wall Street Journal just in. This is fascinating. China and Cuba have reached a secret agreement for China to establish an electronic eavesdropping facility on the island.
Oh, that will be...
That, according to US officials,
sort of news
familiar with highly classified intelligence. That story out just moments ago.
The memory of my parents hiding the newspapers during the Bay of Pigs. They did not want little Tommy and his sister to see them.
To scare you?
That was the tension. I clearly remember feeling the tension, but they used to hide the newspapers. I'm not equating this to Bay of Pigs. I would never do that. But we're in morning TV, so you can do that.
You just did.
Thank you.
The Wall Street Journal saying that Cuba to host secret Chinese spy base focusing on the United States. We've got Anne-Marie this hour.
We have. Is she here? Is she in person, or is she?
I believe she's still here.
She's going to make an appearance.
She hasn't left.
Right.
And because we've got these flight disruptions, maybe she'll never leave.
Yeah,
maybe she's stuck
like
in.
Hanging with Aaron Judge.
I can see she just entered the studio.
She's like,
got to wait for the commercial break, AMH. You can't do that.
She went out to
against
Yankees
the rules.
to see the game last night. She hung out with Aaron for hours.
AMH around the table in about 5 minutes' time. City's Kristen Bidley joining us in a little bit as well from New York. This is Bloomberg.
you up to date with news from around the world. With the first word, I'm Lisa Mateo. Bank of America's Chief Executive Officer Brian Moynihan says that higher capital requirements will impact lending, following reports that large U.S. banks may have to boost their capital by an average of 20%.
The best news about this whole dialogue is they've got an agreement that extends a period of time, so we shouldn't have to deal with this for a while, which is really critical because the United States has to be the beacon of stability, strength in the world. And at times when this discussion's going on and you travel the world, everybody gets fixated on it because the United States is the benchmark of benchmarks. And if it goes completely somehow accidentally, it's a real problem. And so they get all fixated and all this sort of activity into planning for it, what would happen to all our company. It would just be better if it didn't go on.
Moynihan spoke with Bloomberg's David Weston at the Bloomberg Invest Conference in New York. Kim Kardashian says she's looking forward to the relationship she's building with the other founders of Sky Partners.
I'm honestly most looking forward to my relationships with the founders. I'm really fascinated to hear their backstory. I'm a storyteller. I'm so excited just to have the opportunity to help them win.
Kardashian presented her debut private equity fund to a crowd of curious investors in Berlin at the Super Return Conference. I'm Lisa Mateo, and this is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We've got to address how do we make sure we do everything we can to help Ukraine win, but we also have to make sure that we're not wasting dollars. We're going to have $35 trillion worth of debt in 2 years. We got to make sure Germany and France do more than their fair share. Can't just be the American taxpayer that's paying for this. Let's look at lethal aid that's going to help them, Ukraine, win, not just have another prolonged war that goes on forever and ever.
Feels like the latter at the moment for the Ukrainian people, that's for sure. The Senator Rick Scott of Florida on Bloomberg's Balance of Power just yesterday. From New York City this morning, good morning to you all. Let's check in on the price action on the S&P 500. Equity futures just about negative. Let's call it unchanged at the moment. Yields just about higher by a single basis point, 380, much higher in yesterday's session as we get another surprise rate hike this week. The first from Australia, the second out of Canada. Plenty of surprises out of Canada over the last couple of days. The wildfires painting the sky the colour orange over the last couple of days, Tom. The latest news from the FAA in the last 20 minutes or so, that inbound flights to LaGuardia have been grounded on low visibility, Tom. They've been slowing the traffic into New York City airports over the last day or so.
I think Well, with the sunrise, we're going to see a lot more of this. There's no question about it. We saw it yesterday. I believe Newark at one point was limiting incoming. I saw one tweet. I'm not sure the datedness. Right now, Newark across America is 28 minutes delayed incoming. But we're going to see much more of this. And Lisa, you nailed this yesterday, saying it's a movable feast. And as a general statement, it seems to get worse in the afternoon. Is that a theory we can run with here?
To be clear, I am not a weather expert. I was just reading the reports that it was saying that it was coming in and settling as the afternoon went on. There is a real question, though, about sort of business disruptions, especially if people are not able to be outside in schools, even cancel some of their events and their classes.
I think what's important here, John, and I want you to bring in our next guest, she's so special here, is you get out the map, you get out Google, and you look at Taiwan, and you look at the distance to China, 100 miles, 105 miles, who's counting, whatever, like Strait of Hormuz, Persian Gulf.
Sure.
And the distance of Cuba, and it can vary here, but it's 260 miles to, it depends which part of Cuba you're looking at. But the answer is that's going to be the equivalency about something that's going to be talked about nonstop today.
The story just breaking moments ago from the Wall Street Journal this hour that China and Cuba have reached a secret agreement for China to establish an electronic eavesdropping facility on the island of Cuba. That, according to US officials familiar with highly classified intelligence. AMH jumps into the studio, into the hot seat. Good to see you, Anne-Marie.
Good to see you guys.
What do you make of that?
Well, I think it's concerning for the U.S., given the proximity of Cuba to the United States, and potentially what does this mean for China? That means they could potentially monitor things like phone calls, like emails, like satellite transmissions. So obviously U.S. officials would be very concerned about this because this is China exerting more power very close to the U.S. border.
Complete unfair question. Does it derail the trip of the Secretary of State to China?
I don't think it derails the trip at this moment because, remember, they are desperate, the Biden administration, what it feels like with all of these overtures to have invitations to sit down with their counterparts to make sure they are at least having dialogue.
Does China want to sit down with us?
I think China does, but they're using this, of course, as leverage. And it's very awkward for China to say yes to some U.S. meetings when, say, there's a new export control ban on them, when they're hearing the G7 in the United States talk about not decoupling exactly, but de-risking, and that they're going to go forward with an outbound investment restriction. So right now, Secretary of State does plan to go. He would be going in the coming weeks. And we should remember, he was always going, even when U.S. officials knew there was a spy balloon flying over continental U.S. The trip got derailed because the optics became so toxic when it became public.
Well, this to me is one of the most fascinating moments of this political cycle, that politically, among the people, there is this feeling as hawkish as you can get good on China, right? And then the politicians, particularly the Biden administration, is trying to soften things a little bit to get some breathing room. How much can they fight against that, right? I mean, how much is the Biden losing if they do seem to just sort of shrug off the creation of a secret spy facility in Cuba?
Well, this gets very difficult, especially going into 2024, because every presidential nominee who wants to be the Republican candidate is going to be asked about China, and every single one of them is going to be as hawkish as the next. Or you're going to go to the Capitol Hill and talk to those individuals on the China Select Committee who want to be very hawkish. The Biden administration, their actual deliverables on China have been quite hawkish, right? We've seen more from this administration than we've even seen from the Trump administration. The tariffs were kept in place, but at the same time, you'd be hard-pressed to find anyone in Washington who want to take a tough stance on China. You'll also be hard-pressed to find anyone that wants to go to war with Beijing. So the Biden administration at least wants to have some sort of dialogue and rhetoric. Look, the two defense chiefs of these two countries couldn't even sit down in a room together. There was a cordial handshake, and then it was back to barbs.
Extra headline this morning. Inbound ground stop or delays also possible at JFK and Newark. That coming from the FAA, Tom, just seconds ago.
She's got the Gulfstream. I don't know. She goes out of Teterboro or Middletown to the west. I mean, I don't know if it affects Anne-Marie.
That's on the latest from LaGuardia as well. So if you are just tuning into the program, here's the latest from the FAA this morning on some of the potential flight disruptions. Inbound flights to LaGuardia grounded again on low visibility. Elisa, just getting an extra headline from the FAA. The inbound ground stop or delay possible at JFK, Newark and Philadelphia as well.
This comes as President Biden said that he was actually giving a bunch of aid to Emmanuel Macron, to Justin Trudeau, excuse me.
They can be easily mixed up
for many reasons. Over in Canada, that he was delivering some firefighting aid. Do we have a sense of what kind of effort is being placed on that front and whether that's sort of a lasting effort?
So this is what the readout said. It said to date, the U.S. has deployed more than 600 U.S. firefighters and support personnel. Trudeau then came out after that phone call and said they expect the U.S. to continue to send some of that support.
I don't want to play weather guy, but basically Rob Carolyn says there's a ginormous low off Nova Scotia sitting in the Atlantic that won't move. So, I mean, the fires were there last year, right? The fires were there the year before, et cetera. So maybe it's just a freak low sitting off Nova Scotia. It moves out, John. Life goes on Saturday.
You're asking the wrong guy. Hands up.
What are we going to do? Send firefighters up there?
We are. We already sent 600 according to the President of the United States.
Do they have grizzly bear repellent? I mean, they're going way north.
I'm not sure. That's definitely out of my bounds of expertise. What I would say, though, is that what's concerning is that meteorologists are talking about the fact that this could happen more. This could be more likely in the future. We could see more of these forest fires, and it could, start to descend as we're seeing in New York. And actually, Washington D.C. is going to be much worse today.
I'm going to segue here right now on Balance of Power. You'll see this tonight.
I've got no doubt about that.
Anne-Marie, I am dazzled by the House. We have 11 ultra-conservative Congress people who basically have said on a procedural rule, which I really don't understand, we're going to let the minority Democrats run the House. That's this distillate of a frozen House. Let it go, let it go. Is McCarthy heading out the door based on these 11 ultra-right Congress people?
So the ultra-right are not saying we want the minority Democrats to run the show. What they are saying is that we want more power and leverage over the Speaker.
They don't have power. There's 11 of them. That's not power.
No, but what they're saying, and this is what Speaker McCarthy will tell you, is that, these 5 to 11 individuals are trying to hold the entire Congress hostage to get what they want out of him. And he had negotiations with them last night. All of this goes back to potentially what promises were made during the 15 rounds of the speakership early on in the year. And then, of course, all of them, these 11, are very upset with how the debt negotiations went down. They don't think the caps on spending was enough. They want to see more. And at the end of the day, you did have more Democrats, though, vote for that than Republicans. So that plays into their hands.
Is this Scalise of Louisiana just trying to do an end around McCarthy, knock him out the door, and Scalise takes over? I mean, it's like I'm trying to be inside Washington baseball.
We are not there yet, but I will say this. Punchbowl News did have an interview with Steve Scalise, and how he responded to the current state you have from Jake Sherman is it's not good. He said, I don't know what the promises were. I wasn't part of that, so I still don't know what those agreements were. Whatever they are, conservatives feel the agreements were broken. That's got to get resolved. Hopefully it does. Obviously, tale of old time in Washington. At the number 1 and number 2, obviously there's some friction.
This is on the edge of Liz Truss. It's positively British.
It's kind of like John and Tom.
Kind of like that. Is that what this is? TK, why are you surprised? It's politics.
I'm not surprised.
Don't we have
saw it with Ryan. We saw it with
fringe Democrats running the White House? Hasn't that been an argument for the last 2 years?
No, I don't. I think
you
there's
don't
a wide
think that?
understanding.
I think there's a lot of people who believe that in
Democrats.
Washington, D.C., there are fringe Democrats that are basically in charge of who gets hired to the White House, who gets hired into the government and this administration.
That is a thinking amongst many in Washington, D.C., especially during the first 2 years of the Biden administration. Obviously, you're going to see him want to move very much so to the center. Aaron Judge is still in recovery mode. Hopefully, we'll be beating the Red Sox on Friday.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From the Wizards and Capitals to new ventures and innovative investment, running a sports empire in Washington, D.C. is a monumental task. Owner Ted Leonsis trusts CFO Peter Bichet to execute monumental sports and entertainment's financial game plan.
We are definitely in growth mode. What else can we do? How do we grow the platform?
Watch Chief Future Officer, Wednesday on Bloomberg.
August 20th, I can get you tickets for New York Red Bulls versus DC United for $25 each. You go a couple of weeks later, August 26th against Inter Miami. And those tickets, Tom, those tickets start at several hundred US dollars. Right. The difference that one man can make to a sport
Somebody
in
once
America.
told me, when you see these kind of announcements, just the gate helps pay for it.
Just amazing.
The piece they get on the action is
just amazing. Of course, we're discussing Lionel Messi going to
explain
into Miami.
Take a moment here and explain not why he's the best guy in the world, but why he's still so dominant at his age. Is he like when Beckham came over here, or Wayne Rooney, where he's older? And
no, he's older. It's coming towards the end of his career. He's slowed down. He's not as prolific in front of goal, but clearly he's going to be the best player in this league because the gap in terms of talent between what happens in Europe and what happens here is still incredibly wide, and they're trying to build the game. He's just an incredibly talented football player, and you could see it as soon as he burst into the team at Barcelona as a teenager.
Oh, yeah.
I remember seeing it. We all saw it. There are certain players that come along, they step onto the field, you watch the way they move, the way they receive the ball, the confidence they have, the way they move towards goal. You know, sometimes, Tom, players burst into a team, they get the ball, they're scared of it, and they pass it back immediately. This guy was nothing like that. You just knew almost immediately that he was special. Just like that, just one touch on the ball.
The big money that's going into this transaction, is it money looking for an international exposure or an American exposure?
Both. And I would say more so in the United States to begin with. We've done this experiment before with Pelé back in the 70s. Did it with Beckham in the last 20 years. Yeah. This is different, though. It seems to be building on everything we've seen over the last couple of decades. You think about the deal that Michael Jordan did with Nike all those years ago, which I have to say that Matt Damon and Ben Affleck have done a wonderful job putting it into a movie over the last 12 months, Tom. You think about the profit-sharing deal, the revenue-sharing deal they did with Nike and selling sneakers. Just the very idea that now we might have that, reportedly, according to The Athletic this morning, we might have that with Apple TV. They sell these season passes for Major League Soccer, and you might have this profit-sharing agreement with Lionel Messi. That's how big he could be to subscriptions to the game, which is why I also bring up the ticket prices this morning, Bramo, because that's the difference he can make. You can charge $25 at the gate, or you can charge several hundred just with one player joining the roster.
The Taylor Swift effect. I mean,
Big
basically,
time.
this is a rock star coming and going to make it a really significant thing.
So
what I find interesting is that this is competitive with the Middle East money that's been coming into the sport. And this is a direct rebuff, really, to them saying, we'll pay you $400 million to come on board with us, saying, no, thanks. I want to have a stake in this.
Adidas might have a move to bank here as well. I'm going to get the details of this in the next couple of days, the incoming weeks as well. And Lisa, to your point, we'll work out just how prolific this deal could be for him, both from Apple from Adidas, and that's before we even get into wages from Inter Miami, whatever they are.
Yeah, but at this point, though, how much is it interesting to you? And I'd ask you, because I am no expert in this whatsoever, but David Beckham running this team, that the two of them are teaming up to kind of create a new dominant in this field.
Well, part of his deal when he first came over here was at the end of his career that he would have access to buying a franchise in America. So we're kind of building on what happened with Pele, building what happened with Beckham, and then Messi, and you wonder where it goes from here. I mean, I'm a romantic when it comes to sport. I wanted to see him back at Barcelona. It's a shame that didn't happen. But clearly he's come towards the end of his career and wants to do something new and build a new legacy. That's the football stuff. We're going to catch up with Alex Webb a little bit later on Apple. I think that deal with Apple TV is something we all need to take a closer look at and what that could mean for sports going forward. If you're LeBron James and you think you're it in the NBA, you're Aaron Judge at the New York Yankees and you think you're it, do you want a share of that kind of stuff as well? I'm sure some people do. Equities right now on the S&P 500 look a little something like this on the S&P. Futures slightly negative on both the S&P and on the Nasdaq as well. Into the bond market just quickly, 2-year, 10-year, 30-year yields up yesterday off the back of the surprise rate hike from the central bank in Canada. 380 on 10s, 456 on a 2-year. And in Europe, well, I call it a recession. I know some politicians don't like to call it that, but 2 consecutive quarters of negative growth in the Eurozone just about for Q4 and Q1. The Euro Lisa just north of 107, 107.35.
I love the recession or not recession discussion. In the single mover name, I'm really curious about what we've seen over the past few sessions, which is the smaller regional banks. We have seen a revival of them in a pretty significant way. If you look at the KBW Regional Banking Index, it's up 22% since May 11th. And you could see right now, Western Alliance up almost 2%, PacWest up about 4%, US Bancorp along for the ride. Just interesting, again, that people are talking about rate hikes, people are talking about the potential for more dynamism, and people are writing off the banking crisis. Also, just to stick on sport, Manchester United shares, if you take a look at those, they are popping as a result of the 5th bid from Qatar's Sheikh Jassim.
It's been going on
coming
forever.
out. It's been going on forever. They were up a lot more earlier. They're up 2.3%. I wonder how much this is Man City's wins basically coming in, people getting really sort of negative on them. How does Manchester United push back against it? I mean, this is really the story as the Middle East and frankly oil money comes in and dominates a lot of the major sport in a big way.
I think there's a hope from both shareholders and Manchester United fans alike that they take the highest offer and they get rid of the club. And I'm talking about the Glazers of the Tampa Bay Buccaneers, right? There's a hope that they just step away. There was a fear that they hold on to some kind of minority stake and hang around. And this one's been dragging on for months. I've been waiting for the conclusion for this for a long time. I can guarantee you one thing, we will get jobless claims in about an hour. Coming up in about 55 minutes from now. Looking ahead to next week, CPI data on Tuesday, ahead of the Fed decision on Wednesday. Christina Campmany of Invesco weighing in on some of this, saying, we believe the more optimal and palatable path for the Fed is actually to hike in June and then more clearly communicate they're comfortable with the level of restrictiveness at this point and want to wait a full quarter to access incoming data. So, Tom, it's kind of data dependent, but not. Sort of data dependent over 3 months instead of every month.
And to recalibrate here into July and to the end of the year, given the mysteries out there, Christina Campmany joins us now, Senior Portfolio Manager, Global Debt at Invesco. And the note, it's not that your note is ambiguous, you're just waiting for the data to come in like everybody else. Do you manage now for coupon or for total return?
I think with the Fed, look, they've changed their messaging, and we've always kind of been in the camp that I think the bar is for them to go in June unless data changes, and I think the messaging in the last 2 weeks has shifted that, and I think the message is that in some sense it is more palatable, especially if you look from a global central bank, because as much as the Fed doesn't want to be the central bank for the globe, in some sense they are, and especially for these emerging market central banks who have moved proactively and moved early and want to adjust, they feel like they're handcuffed by the Fed.
What is the duration bet on price up or price down on global debt?
Yeah, so I think treasuries kind of look fair here. I think it's a range-bound market. I think what looks interesting in the U.S. is actually tips. Real yields, 5-year real yields are at 170. I think that looks interesting both. Like, we don't view this hard landing deep recession camp, but it actually should perform in that environment as well. And now at 170, I think that provides a good place to park some duration because we have moved a lot. we are closer to the end of the Fed cycle than the beginning.
How disruptive would it be if the Fed did not skip and they actually raised rates next week?
I think that is, in some sense, the more palatable option. A week ago, we were priced for that, and this change in language from pause to skip and trying to communicate that a pause isn't a permanent on hold and cuts are imminent. But I think it's more disruptive for them to not go in June and go in July. You have 5 or 6 weeks of data. You don't have materially more information on what's happened tightening-wise from the banking sector. You have one payroll and one CPI. Like, do you really have a lot more context about the market in that period of time? That's hard.
Does it make sense to you to both see the Fed hiking next week and also be bullish on credit here, be bullish on risk, be bullish on the idea that this economy has momentum, even if it means the Fed's going to be more aggressive?
In terms of, is the Fed bullish on credit and risk,
Whether
or the market? So I think for us, the last 9 months, and maybe almost we're approaching a year, the market has imminently looked for this slowdown in growth, slowdown in the consumer, a look for payroll, job creation to imminently fall off, and we haven't seen that. The consumer has been robust. And I think what we find is in a easing cycle that passes through to the market much more quickly than it's passing through in a hiking cycle. So there are lags, and we need to be able to transition from just looking at concurrent data to assessing these lags. And I think, again, it still is this data dependent. And Jonathan, you've said this before, like saying it's data dependent is silly. It's always data dependent, of course.
But are you basically saying that it's too soon to go into some of the higher risk securities?
So when we look, we'd prefer macro risks rather than credit product. And I think like within the credit product, mortgages look interesting because of where they are, and there's a short rate vol bias. We'd be more biased up in credit within credit, so IG over high yields. But I think the more compelling lever that we see are the macro levers, and probably FX the most over rates even.
The reality for our listeners and our viewers is not a lot of data dependent, forward looking by strategists and all that. The reality is they're down 17% from the good times in bonds, and they've come back maybe 6%. We had somebody in the other day that said 80 is the new par. Do we need to reset our bond view, thinking that we're not going to get back to the glory that we knew a number of years ago in price?
Yeah, I think it's a different world. I think we're in a world with higher inflation, and we've reset. And I don't think the 30-year, 35-year bond rally that we had in one direction
I got to make some news here this morning. Is the 35-year bond rally dead?
I think we're in a different environment. I think the risk is that inflation is here to stay in a more meaningful way. And that doesn't mean the 8-10% inflation. We've obviously come down, and we have CPI next week, but we're still talking, even if you're talking 0.3 risk or 0.5 versus the 0.4 consensus, you're still running at 5% headline and 5.5% core. Like, that is not the Fed's goal.
Above target inflation, here to stay for a while maybe. Christina Campmany of Invesco, really revealing, listening to the former Fed Vice Chair Richard Clouder this week over in Newport Beach, California, catching up with him at PIMCO. Talking about accepting 2 point something. That's a real change. Talking about accepting 2 point something.
The something word, 2.x.
Whatever the something might be, and just sitting there and saying, this is where we are. We want to get back towards 2, but just carry on forecasting we're going to get back towards 2 without actually being back at 2.
They had a brilliant symposium at the Dallas Fed, I'm going to say 10 years ago, for John Taylor, and it's real simple. First of all, it's not 2%. It's 1.x% is where we've been. So you blow through 2, and if you get declared as new level, you're a stick above at 2.6, 2.8. Is that where we're heading? That's a huge debate.
I remember the morning last year, Matt Lazzetti of Deutsche Bank comes out early and calls for a US recession, and he hasn't changed that call since. We'll talk about the date, the magnitude of it. We'll catch up with Matt in about 50 minutes' time. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Some 230 square miles of Ukraine's southern Kherson region is underwater 2 days after the destruction of the Kakhovka Dam. The regional governor says almost a third of the flood zone, where thousands are being evacuated, is held by Ukrainian forces, while the rest is in Russian-occupied territory. Kyiv is assessing the humanitarian, economic, and ecological damage of the disaster that Western leaders denounced as a war crime. Uber Technologies wants to cut emissions to zero by converting its entire fleet of cars to electric by 2040. But to do so, Uber CEO says the ride-hailing giant will need support from both drivers and riders.
Teslas are the highest selling cars in terms of electric vehicles by a mile. At the same time, we're not, we want electrification to happen. And that's not just going to happen with Tesla. We need Fords out there, GMs out there, Toyotas out there, et cetera. We need all these other players to go electric.
President Biden has vetoed a bill initiated by congressional Republicans that was designed to repeal the administration's student debt cancellation plan. Biden's executive action would forgive up to $20,000 in federal student loans for some borrowers. But the battle is far from over, as his plan still faces justices in the Supreme Court. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
One conviction view that we have is this higher for longer narrative globally, and we're talking about potentially no cuts from major central banks at all until at least the second half of next year. Wow. Whereas that is not something that's priced in, I would say, the Fed or anywhere globally, because it's sticky inflation, persistent inflation, and fiscal is only going to make that worse. And we've got quite a few elections coming up globally over the next 18 months as well, and we love electoral giveaways on the fiscal side, don't we?
What an amazing conversation with Jeff Yu there, Senior Market Strategist at BNY Mellon. The electoral risk around fiscal policy, and that risk is something the central bankers might have to be focused on in the coming 18 months or so. From New York, welcome to the program. Flight delays expected across airports in the New York City area, including in Philadelphia as well. Look out for that across the country. The latest news a little bit earlier this morning that flights were grounded at LaGuardia. Plenty more news since then. Elsewhere in the market, not much news to talk about, I have to say, at the headline level on the S&P 500, just a little bit softer. Continuation of yesterday, just a little bit in the bond market. Yields higher by a single basis point, 380.70 on a US 10-year. Surprise rate hikes this week, Australia, Canada. Teeing us up for next week, will we get a surprise out of the Federal Reserve? The Federal Reserve and Chairman Powell does not like to surprise. Let's see if they do just that next week. Citi's Andrew Hollenhorst is sticking with it, still thinks a hike next week. Let's see if they drop that call or stick with it after CPI on Tuesday morning. One story we need to discuss this morning, though, Tom, is just this phenomenal deal between Lionel Messi, one of the greatest, if not the greatest player ever in football, and Major League Soccer and Inter Miami. Into Miami.
Single sentence here for those that really don't follow this, and you know, the kids walk by me with the Argentinian shirt on, the white and blue stripes, and I guess I get it, but I don't. You mentioned Pele earlier. That was from another time and place. Multiple sources involved in or briefed said earlier this week that the American Soccer League and Apple have discussed offering Mr. Messi a share of the revenue generated by, I can't believe the detail, new subscribers to the MLS Season Pass, the streaming package on Apple TV Plus. You mentioned this before, but to see the language, John,
that's
is
amazing.
Even more shocking.
They've got a $2.5 billion 10-year deal with Major League Soccer. I'm talking about Apple TV. And clearly they think this can go some way to generating real subs.
It's a whole new world after all, because, I mean, betting was banned until a number of years ago now. And in baseball pregame, they're literally giving you the odds of how badly the Red Sox will lose in a given night.
We need to talk about the business of this. We can do that with Alex Webb over in London. He joins us from Bloomberg in the city. Alex, let's start here and focus on the business. How big is this deal for Lionel Messi, and what kind of precedents are we setting here?
Well, we should say they haven't actually signed a deal yet. It's almost like an MOU, right? They intend to sign a deal. They're working out the details. But yeah, the reports are not only that Apple could do some sort of revenue sharing deal on the new subs that come to the MLS ticket pass that they offer through Apple TV Plus, also through Adidas, which is already the boot sponsor for Messi himself, that they might also do some sort of revenue split. They make all the jerseys in the MLS. It is potentially a massive deal if he gets a slice of all that. There has sort of been precedent for this before. When Beckham joined the MLS 15, 16 years ago, he got the opportunity to buy a franchise, to get the franchise rights for $25 million was reported at the time, at an undefined future date. When he finally did it a decade later, franchise rights were selling for $300 million. So he automatically converted a 25 million stake, tenfold. So they are quite canny in the MLS at finding ways of attracting these big players without massively breaking the salary caps that some of these teams have.
There's a distinction here, though, with Apple, with this idea that one of these streamers, one of the distributors of the sport, is having an active role in helping foster who will be playing on the field, who will be in their roster. How much is that going to be something of a template versus a one-off for some of the streaming services that want to get in on the sport that is capturing the eyeballs and possibly the one thing keeping afloat the traditional sort of plug-in media?
I think Messi's pretty much an exceptional case, as John quite rightly said. Many will argue he's the greatest player of all time. I think that a lot of other people would struggle to say, I want the same deal as Messi, and might be laughed out the room. What you might see is in other sports, right? In other sports where streamers have rights, whether it's UFC, whether it's something else, that they will try to get a chunk of the gross. Right. Also, that they might make little documentaries. They might make a documentary about a given player that then also gives them a cut of some streaming dollar. Apple TV Plus has got a Messi documentary that clearly Messi himself is benefiting from. So there's a slice of a template there. I don't think anyone else is going to be getting exactly this deal.
Alex, James Knowlton over at The Guardian did a nice summary, I'll say 2 months ago, of how MLS in America just really hasn't cut through. Do you look at this, and I mean this within all of the Alex Webb media analysis you do, is this just rich guys playing, or is there a legitimate league out there that people will care about?
I think MLS is starting to reach an inflection point. Like, I did some analysis a few months ago when you're looking at that franchise value, and actually, if the pace at which the franchise rights value is accelerating, you tally that against the pace at which rights in NHL, which is historically the kind of fourth biggest major league in US sports, MLS is on track to overtake it within the decade, right? So it is really starting to nibble at the heels of NHL. NHL is still quite a bit bigger, has more games, that obviously helps it, but this is a real business.
John?
And one final thought on this is that unlike other soccer leagues, because there's no relegation or promotion, there's a revenue sharing, there's broadcasting sharing pretty evenly. It is a lot safer an investment than buying, for example, Manchester United, right? Because you have a far better visibility into the earnings profile in a few years' time.
Did Alex Webb just announce that Manchester United is getting relegated next year?
He
think
didn't.
That's what he alluded to.
He didn't go that
What
far.
are your thoughts on this, John?
Look, I think what we're seeing across sport, we're witnessing that these guys aren't athletes, they're content providers. And a great example of that over the last couple of years has been Liberty Media buying Formula One and what they've managed to do on Netflix. And what you're seeing is Apple view Messi not as an athlete, but as someone who can provide content for them that they can sell. And Messi's got to sit there and say, you know what, I want a slice of that.
So what I'm hearing
if I'm going to bring you revenue. And that's the way sport has changed much more so in the last few years. Think of Ryan Reynolds buying Wrexham. He didn't see that purchase as owning a football club. He saw it as a way of providing content from a streaming service, Amazon, who's going to pay him money to create content.
You agree with Alex that this is not rich guys playing, that there's a legitimate future for this league that 99% of our audience doesn't care about? Yeah.
This isn't the same as Saudi money at all.
Okay.
Not at all. The Saudi issue with the Saudi government, that's a PR story. That's about soft power. That's about sovereign states getting a foothold in very popular sports. I think what you're seeing in MLS in this deal between Lionel Messi and potentially Adidas and Apple, building on the legacy of what Michael Jordan did with sneakers. Yet we're doing this now for global media. And I'll say it again, Tom, we're doing it with Formula One. We're doing it with Wrexham and Ryan Reynolds, and we're doing it potentially with Apple and Lionel Messi.
Cheers to everybody on radio and TV who had family watch the Air Jordan movie, and then, of course, we had to go out and buy Air Jordan movies. We had to buy 2 pair of Air Jordans.
How cool was that?
Oh, it's great. Loved the movie. It was really, really quite good.
Building on the legacy of Michael Jordan's mother, who had the foresight to ultimately push for that deal.
Well, this, to be honest with Alex Webb, this seems like a shift, much like what Mrs. Jordan accomplished. It's a different,
in potentially bigger and more complicated ways. Alex, thank you. Alex Webb there of Bloomberg Quick Take
become like
on the latest.
He's not a contributor. Alex Webb should just be on daily. I mean, he's like.
We can come on daily. What would you like him to discuss? Just anything. We do TK roulette. You just spin the wheel, Tom.
Sums it,
whatever it lands on.
He just does NVIDIA and.
That's like the show sometimes. TK roulette. Just spins the wheel, whatever it lands on. It's in the zeitgeist.
Hey, Emery nailed the Red Sox-Yankees series coming up. What a train wreck that's going to be.
This weekend, is that even happening anymore? What's going on with that?
Well, that's a serious question. You've seen the weather changes here. I mean, I don't even know what a ground stop is. FAA cancels ground stop at LaGuardia. I think that's where they're out on the runway, sitting there. I don't know.
Just the plane's grounded?
Yeah, I don't know.
That seems to be the way that works.
Stuff. Yeah.
Kristen Bidley at Citi is going to join us on her mid-year outlook next.
Welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. I'm Johnny Ray Diaz. World number 1 Iga Swiatek took out Coco Gauff in a repeat of last year's final to reach the semifinals in Paris. The defending champion closing out the win in just under an hour and a half and is now unbeaten against the American in 7 meetings. The victory improves Swiatek's record at the clay court slam to 26-2. I'm Johnny Ray Diaz.
So most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No. Rambo was a novel by David Morrell. And I was the 11th choice. Everyone. It was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time you go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back
into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
I think the recession story is frankly off the table at this point.
We're not going to have a recession here, but we are in an asset price recession.
I'm just not convinced that we are going to be able to see growth with the kind of resilience that we're seeing now.
The economy actually in the US remains on a very robust footing at the moment.
At the moment, the US is not our favorite region. But if you're looking at over a 10-year period, do you want to be focused on the US or Europe? Well, it's 100% US.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, in difficult weather conditions in New York City. We're monitoring the airports, of course, this fire, the fumes, the smoke that we've had come in through the day, and we will stay focused here in this hour on claims at 8:30 and far more on the state of the market. John, mid-year outlooks are out. We're overwhelmed with 40-page beautiful documents about what to do forward.
Overwhelmed and beaten up by the last 6 months. Just a bunch of consensus views shredded.
You mentioned
Whether
the dollar.
It's the dollar,
weak dollar.
take
It's
your
going to
pick.
happen.
China, Europe outperforming. Tech's going to be bad. Tech absolutely ripped. Hello, Nvidia.
Don't own Apple.
Hello, Meta. Hello, Apple. Take your pick. And now we've got surprises this week. Australia, Canada. What does the future hold for the Federal Reserve? That statement from Governor Macklem, do we get the same thing from Chairman Powell in 6 months' time after announcing a conditional pause that they have to restart interest rate hikes because we're not sufficiently restrictive? That's why some people were spooked yesterday.
I thought yesterday was there, and in the opening of the show, you saw the many divergent opinions that we had here, and we're going to really address this head on with J.P. Morgan Private Bank here in a moment. But to me, John, given the view to the Fed, it's for the people on the sidelines. How do you get into the game if you've missed this?
Comfortable in cash at 5%. Still comfortable in cash
Didn't
at 5%.
listen to Ed Yardeni in October.
I'm still comfortable in cash at 5%, and then it goes higher.
Yeah.
It goes higher, and all of a sudden you've missed out on a 30% rally on the NASDAQ and 100% plus on Meta and Nvidia.
We've got Ira Jersey scheduler. Lisa, brief us on 5% T-bills. I mean, it's just a whole uproar right now that we're all going to die in the next 90 days.
Is there?
Because there's like the debt crisis is over, and T-bills are going to do this or do that. I mean,
that was the narrative that died on Monday. I think that people came into the week saying that potentially we could get a real sucking sound of liquidity out of the market because of the T-bill sales. And then people said we really just had nothing else to talk about. I mean, if you really talk to them quietly. So people have kind of put that storyline aside. There is this larger issue, though. Everyone has moved on from some of the stresses of the fact that bank deposits cost something and that people are now going into T-bills and going out of those deposit accounts. The lack in lending is just really unclear right now, and people don't have a sense of what that slow-moving train really looks like.
That's a two-part economy. We've had some guests here that have really talked about, Marilyn Watson at BlackRock was talking about a pretty buoyant America. And others, John, there's a huge set of gloom out there. Maybe it's centered around housing and the oddities of the mortgage rate, but there's a lot of gloom out there right now. I see it in the buying of puts, the betting on markets going down.
I had a nice back and forth yesterday with an economist, a well-known economist on Wall Street, and just said, the post-pandemic distortions are still here.
Yeah.
We pulled forward demand of physical things. We're all trying to buy stuff in a pandemic, pushed out demand for services, still witnessing that demand for services right now, re-engaging with things like flying, tourism, TK, no sign of that slowing down anytime soon based on what the airlines have been telling us.
I'll be with Nassim Taleb here in about 2 hours with Bloomberg Invest as well. We'll talk there about the black swans that are out there right now. John, I don't even know where to begin on the data check. I'm going to go to a near 4% 30-year bond. Haven't talked much about it, but once again, yields rising and out in the distance, 4% beckons.
We should also go to the importance of round numbers on SPX, on the S&P 500. Apparently, we don't like 4,300. We like 42.99, but can't hold that for very long. 42.99.19 yesterday, higher the session. Monday, 42.99.28, higher the session. Can we break 43?
Ed Giardini, 4,600.
I know.
Tony Dwyer, 2,200.
Did you work that out?
No, we're doing math with Tony Dwyer, folks. He didn't want to give us a point estimate.
Was it 11 times earnings on what? I forget what the earnings number was.
Last time he's on the show.
11 times earnings was a joke, by the way. Just, anyway.
What we're going to do right now is move on. We'll continue to give you airline headlines as they come out, given the really horrific conditions on the West Coast. Philadelphia hit hardest. But right now, and this is really important, on radio and television, if you want to know at the margin where to allocate next, listen carefully to Kristen Bitterly, head of North America Investments at Citi Global Wealth. We're thrilled she could join us today. There's a buried sentence in the usual blather of a mid-year outlook that you released today, which is, are you playing defense or are you being on the sidelines? That is a perfect metaphor for the emotion right now.
I think that's exactly right. There's this feeling out there that you're either all in or all out of the market. That I think you guys were talking about this earlier on the program, this idea that you're either all in T-bills and sitting in that 5%, or somehow you're chasing and finding a defensive play in tech stocks. And so what we've done, and this is something that we've done from the very beginning of the year, is we've actually been very balanced in terms of our fixed income portfolios, our equity portfolios, where we are fully invested, but we're picking our spots in those asset classes in terms of quality. And when you look at the performance of something like that year to date, it's actually high single-digit returns for a balanced portfolio. It's not the 25% of the NASDAQ, but it's certainly strong returns year to date.
Stan Druckenmiller was great yesterday with Sonali Basak. He talked about the prospect of going into recession and compared almost staples to what's happening with AI and NVIDIA. Can I compare, can I put in the same bucket some of these tech names with consumer staples?
I would love to hear that in more detail. I think that would be a challenging analysis to do. But I think when we talk about what's happened within the market more broadly, I do think this concentration, and everyone's talking about this is not a new story about the breadth in the market. The breadth in the market, those 7 stocks representing more than 100% of the gains. Even if you look, it's not a uniquely U.S. story. That's a global story as well, that there's 10 companies representing 85% of the global gains. And so what does that tell me? It actually tells me that the market is pretty rational. Where the money has been going into has been these mega cap companies with strong free cash flow generation, the ability to fund growth, not dependent on credit markets, have their balance sheets in order, and a lot of them have raised guidance going forward.
So given that, right, given that maybe there's rationality, but maybe you don't want to play that because you can't really predict the AI future, are you starting to now say that the rational plays of, say, regional banks, of, say, just generally financials, areas that have gotten beaten up, are looking good again if things aren't that bad.
That's one of the themes in our outlook is actually this coming rotation within equities. So as I mentioned earlier, we have been playing defense. We've been invested in areas like global dividend growers, but some of the areas that we've been eyeing and adding exposure. So something like mid-cap, right? So looking at mid-cap and the valuation differential, trading at about a 28% discount to larger cap. Looking at some of those themes, you have to be selective. This isn't just kind of a broad brush. You want profitable companies just like you want profitable companies in large cap. But that's an area when people ask the question, has this theme gotten away from me? You can actually find opportunities just going down the cap structure.
One thing we've been talking about throughout the morning is the weight of people who have been hiding in T-bills to go into NVIDIA, to go into big tech, to look for those double-digit returns that you were talking about and not be happy with single-digit returns, even if they look pretty good on a risk-adjusted level. You've been traveling a lot, talking with clients. What do they say? How much pressure are you hearing to get a little bit more with respect to earnings?
I think everyone is asking that question of, is tech a buy? Should I continue to chase this rally? And I think one of the most interesting things, bringing it back to the AI conversation, because we have to, right? That's just the dominant conversation right now. I think there are fabulous companies out there, but they're valued at, an even more extreme level. And so in terms of making money in any type of market, it's really that differential. And so some of the areas that, if you think of the net beneficiaries of AI, the concentration has really been in those mega cap companies. But then when you look at areas like cybersecurity, that's going to have to come along for the ride. Areas like one of our long-term unstoppable trends is investing in longevity, a net beneficiary of this technology where you haven't seen that type of valuation and you haven't seen the funds really come into those areas. Those are ways to be invested, but not in a pure play.
Just quickly, what's special about 4,300 on the S&P?
I don't think anything special about 4,300.
What is it about getting into 42.99 this week and just stopping there and pulling back?
I think the major conversation is once we hit that 20% appreciation level and this idea that all of a sudden it would turn into a true bull market, I think we have to look at whether you're in the camp of higher for longer in interest rates or you're in the camp that we could see a cut at the end of this year. If there is some type of recession ultimately and it has to signal that we're going to see further contraction within earnings. And that's something that I think the outlook right now is a little bit too rosy. That was one thing coming into this year. We thought we were going to see about a 10% contraction in earnings. We've reduced that. We think it's going to be about a 6% based on the strong Q1, but still a contraction.
This conversation is of 15 years ago. I'm not used to a normal conversation that was in Febosi or in, the CFA curricula. I mean, it's shocking to hear this. It's like, a normal conversation after 15 years of oddity. We're all recalibrating.
15 years of zero rates, is that what you're referring to?
Yeah, and there was no risk-free rate. The Sharpe ratio didn't work. I mean, it's all there is to it, and we all made it up as we went. And what's so important here, John, is all the focus of the media, the financial press, is on short covering, a short squeeze, convexity to the upside, stuff I don't even understand. And you know what it's about? The Bitterly world, the David Kelly world, which is the basic idea, do you have the courage to get off the sidelines? That's the heart of the matter.
The cash trap. Yeah. It's been a feature of the show for the last few weeks. Kristen, thank you.
Thank you.
Kristen Bidley, Citi Global Wealth Management. Just the latest on the East Coast air crisis, and I think we can call it that, over the last couple of days. So here's our latest, that this blanket of heavily polluted air covering much of the eastern coast of this United States, Tom, likely to linger until Tuesday.
It's a bombshell. This is a real adjustment here, and this is from the authorities, the U.S. Weather Protection Group over at NOAA, N-O-A-A. And the answer is these are the pros in the room. They've got all the tools, all the whiz-bangs, and Zach Taylor over there and others extend this out from the Saturday-ish talk out to Tuesday. They say there'll be elements of less or more, but all of a sudden, we need to reframe this to Tuesday.
Expecting some flight cancellations today, some delays across airports in New York City and beyond, over to Philadelphia as well, so look out for some of that. I just caught at the corner of my eye Matt Lazzetti at Deutsche Bank walking into the building. We're going to catch up with him around this table in about 20 minutes' time. In the next hour on Bloomberg TV, on the Open, Seth Carpenter of Morgan Stanley, Colin Martin, Charles Schwab, Amanda Lynham of BlackRock. All of that coming up shortly. From New York, this is Bloomberg.
Keeping you
you up to date with news from around the world with the first word. I'm Lisa Mateo. The Federal Aviation Administration says inbound flights at LaGuardia Airport have been grounded due to poor visibility, and further ground stops are also possible at JFK, Newark, and Teterboro. Now in Philadelphia, the region faced the worst air quality in the U.S. early today as the impact ripples south. Large swaths of the Northeast and Mid-Atlantic experience unhealthy levels of pollution, while the National Weather Service warned of deteriorating conditions into Alabama and Georgia. And President Joe Biden offered additional support to fight those blazes as the effects of the smoke blanketed some of the cities with an apocalyptic tinge, forcing officials to urge residents to stay indoors. New York State planned to distribute 1 million N95 masks on today. Now, the Federal Aviation Administration continued to report flight delays due to low visibility. And Twitter co-founder and former CEO Evan Williams and one of the most critical members of the founding team, Jason Goldman, had a few words about the direction of their former company. They spoke with Bloomberg about Elon Musk's takeover and how the brand will survive.
I think that's hard. I think brand recovery is much harder, and now the brand is very linked to Elon. Should it be a company? Yeah. Should the internet be a company? No. And guess what? Anyone can make a new Twitter or a better Twitter or just a whole new paradigm on the internet. And lots of people are trying right now, and that's really cool.
They also spoke more about Silicon Valley's new era of austerity and the future of social media. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
We are at the beginning of a very classic late big cycle debt crisis when the supply-demand gap, when you're producing too much debt, and you have also a shortage of buyers.
Ray Dalio of Bridgewater, and of course the founder there, I should say. He's in some levels of retirement. Maybe he'll help the New York soccer team compete with Messi in Miami here. Ray Dalio at the Bloomberg Invest Conference. And I really want to say that coming out of the pandemic with all the opportunities of getting people together, it's an extraordinary Bloomberg Invest Conference. Mr. Druckenmiller yesterday making global headlines, moving the markets. Today, there's a guy from Goldman Sachs that'll wander by, Mr. Waldron. Katie Cottrell joined from TCW, the West Coast powerhouse. And in the middle, I am thrilled that I will speak to my good friend, Nassim Taleb, now of University. Scott Patterson's killed it with Chaos Kings. This is the book. I may launch it to the book of the summer here. Still not too late for that. But this is outstanding on Spitznagel and Taleb as well. Can't really say enough about it. We're going to dive into that in our seminar. I believe radio and TV are going to cover that. They're also going to cover here, where the market's -3, the bond market. And our bond panel of the last 2 days will be led by Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, and joins Lisa and I this morning here. I want to get to the OMG, we're all going to die, Ira. And that is not messy in Miami. We'll see if we have time for that. It's T-bills after the debt crisis. There's going to be an overwhelming flood of T-bills, and the money market funds won't sop them up, and crisis chaos will assume. You go, maybe not.
Well, what we've seen so far this week is that there's actually been quite strong demand for the T-bills that are coming out, because remember, going into the debt ceiling crisis, and because of it, the Treasury Department actually reduced the amount of bills outstanding. And with all the money flowing out of bank deposits and into money market mutual funds to get the higher yields, there's just been a lot of demand for that paper. So there probably is a point where bills have to be much cheaper in order for 2a7 money market mutual funds to care, but we're not there yet. And I think the next week's auctions will still be pretty strong.
Yesterday, the Bank of Canada, and actually just Canada in general, as John was mentioning, it really sucked the oxygen out of the room in a lot of ways.
Yeah.
But one of the things that the Bank of Canada did was they raised rates even though they weren't expected to by a consensus. This followed what we saw from the Reserve Bank of Australia, and it raises the question of whether we could see something similar from the Federal Reserve next week. Do you give any credence to those kinds of discussions?
Yeah, I think it's not completely out of the question. And I think we have an interesting dynamic right now do I think that the Federal Reserve should hike interest rates more? I don't think that they have to, but I think that the Federal Reserve is still worried about the inflationary environment that we have, and the fact that inflation hasn't declined as quickly as they had hoped. So when we get the CPI report for May on Tuesday morning, right when they're about to start their meeting, that could really signal, if that comes in even hotter, or you wind up getting a 0.4 or 0.5 on headline CPI on a month-to-month basis, it's possible that the Fed could say we have to hike, because if they don't hike, then the market's probably going to say, well, maybe they're done.
But the problem is, what's changed, right? It's 1 week, everyone's talking about we're going into recession, the banks are going to have a massive crisis, we're just seeing the beginning of it, the long and variable lags. The next week we're talking about we're totally missing the boat, the resilience is unbelievable, and you're seeing the lag effects of the stimulus from the pandemic. Yeah. What has shifted so violently to spur the shift in sentiment?
It's nothing. And I think that just shows you how fragile people's sentiment actually is right now, and how undecided a lot of investors are in whether or not the Federal Reserve's 500 basis points of interest rate increases is enough or not. And so I think that we're at the point, and this always happens whenever you reach the top or the bottom, is it's a will they or won't they. Now, they haven't cut interest rates to zero, right? We knew that kind of when interest rates got to zero that they were done cutting. But when interest rates are on the upside, there still is that little bit of wiggle room that the Federal Reserve might decide to take. Now, I think what the market's mispricing, if we were going to talk about the very short-term mispricing, is that if the Fed is on hold, that does decide not to hike next week, July is not a done deal, and the market right now is pricing for the Fed to be a done deal and hike in July if they skip in June, and I think that it's more like a 50-50 in July if they decide not to go.
I got 8 ways to go here. And to remind people, this is Ira Jersey, where the world stopped long ago at Credit Suisse with Dominique Constant and others over shocking minutiae, which I think I studied and flunked on a number of exams. And Ira's like legitimate adult on this stuff. Do you frame 6% yields, 5.90, 6.00, 6.1% full faith and credit yields?
Well, I think it will be very difficult for longer-term yields, like 10-year yields, to get up to those kinds of levels. Because even if the Federal Reserve were to hike, say, to 6%, and
stay there is
they would have to stay there for a very long period of time. You still probably only get 10-year yields, say, up to 4.5% or 5%. You don't get them up to 6%, primarily because as soon as the Fed stops, the market is going to always be pricing for interest rate cuts later. The question will be to what magnitude and what that terminal floor is.
But witness T-bills in the last couple of weeks, what you and I were weaned on is the foreigners always came in and rescued with demand for our paper, pushing price up and yield down. We'd literally try to model the Greenspan delta there of 3/4, 75 basis points, whatever. Is that why won't that repeat again?
Well, it could, and you're seeing that in private investors. So you have to break out what's going on with some of the foreign dynamic. And on the panel later today, that's one of the questions that I want to talk with our chief investor. I am a little bit.
Doing that.
You're doing great. Keep going.
But it's the dynamics between central banks who are not yet really full-out buyers of the short end of the yield curve, as you were alluding to, and private investors, foreign investors that are buying the long end, that tend to buy more 10-year, 30-year debt. And that's one of the reasons why I think you have some of these yield curve dynamics that we're seeing. And there's no reason why that won't continue, because you still have the U.S. is relatively cheap. So yields are higher here in the U.S. than they are in a lot of the rest of the world.
Tom said something in the last hour that I thought was fascinating when we were just speaking just a couple minutes ago. And he said, this is a conversation we would have been having 15 years ago. This is something people keep saying. Suddenly, for the first time in 2 decades, the Fed doesn't matter as much. This isn't about where they push rates. This isn't about accommodation. How much is that really driving the theses that you're hearing as well from investors as you talk with them? Not necessarily, well, the Fed's going to do this. This is our benchmark, but more, this is the distortion here. Maybe we can play this in the short term because we have no clue what's going to happen.
Well, I think it's the no clue of what's going to happen aspect of the market dynamics currently that are the issue. And you're right. Like the Federal Reserve hiking another 25 or even 50 basis points is way less important than the fact that they already hiked 500 basis points, right? So you can take the Federal Reserve a little bit out of the market. That being said, I think that there is a lot of questions about what's going on with the banks, what's going on in the financial sector, going back to the rebuild of the Treasury's cash balance with all of this T-bill issuance might create more volatility in the markets. We all remember September 2019 when reserve balances got to what I call the tipping point. Some people call it the lowest common level of reserves or whatever it's called, but let's call it the tipping point for now. Once we get to that reserve tipping point, you could see significant volatility in funding markets. That will creep into risk asset markets. Right. And we wind up with a lot of volatility where the Federal Reserve becomes important again, because the Fed will have to do something because they've created this issue kind of artificially by having so many reserves in the system.
All right, Jersey, stay with us. We got to comment on this. This is just out in Bloomberg News reports that Virginia Drosos in Hamilton, Bermuda, with Signet Jewelers, Lisa. Signet CEO says couples buying lower-priced engagement rings. I mean, there's an economic bellwether if I've ever seen one.
Yeah, I mean, we saw it with respect to people trading down from Whole Foods to Walmart for their grocery shopping. This is perhaps a step further. It's a pretty significant investment, and it seems like this trade down is happening in more sectors, but it really feeds into this theme. People are deciding where they want to spend their money. They might travel more, but that doesn't mean that they're necessarily also going to buy a Cartier ring.
Well, double digit. No, we're not going to buy a Cartier ring, are we, Ira? Double digit same-store sales down as well. But, there's little things here which get into the growth. We don't have time to continue with Ira because his entourage is saying he's got to go up to his panel right now. But, these are important things. Frankly, I think that what the Signet Blue Nile diamond ring person says is just as important as what some Fed president says when you tell me six are talking.
Absolutely. And it is telling you there is discretion starting to feed into the market.
Stay with us. Claims next. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Bloomberg surveillance worldwide on radio and television. John Farrell preparing for the next hour. I'll have Nassim Taleb here coming up at 9 or 10 o'clock hour. Unsure when that is. Looking forward to that. And we get to claims here in a moment. Lisa, we got to talk about the fog that's out there. It's not fog. It's really serious. People with headaches, people really affected all across the Northeast down to Washington.
And businesses closing early in some places as well because people are trying to protect themselves and their workers. This comes at a time where we're getting news that it's going to be maybe even until Tuesday until the weather patterns change. This has been your weather report. But this is serious. It's serious for a lot of people, and it really highlights the nature of the interconnectedness of fires, the worst wildfires that Canada has ever seen.
Washington affected. Their rating of air quality is a little better than New York, which is not saying much. Let's call them both unhealthy. Philadelphia is hazardous, and also hazardous is going to Michael McKee for the claims data when it's not there. I mean, do you see it, Mike? I don't see it in the Bloomberg.
It is a bit of a problem. It is
a bit hazardous.
Maybe the smoke has
breaking
gotten the
news.
focus of your Department of Labor, or maybe they laid off the person who's supposed to put it into the system. There we go. 261,000, so a significant change in the number of jobless claims. That is about 30,000 more than we had in the prior week. I'm looking for the revision that comes over more slowly. 1,757,000 continuing claims, which is a drop. But remember, not every claim gets paid and not everybody stays on jobless claims. So that is not unusual. But 261,000 is a fairly impressive number in the sense of we were looking for a decline. So here's the revision, 233. So it's a gain of 28,000 in the week. Now, it's 1 week. I'll warn you that, and it always is not worth changing all of your views on the Fed and the markets based on 1 week's data. But if
let's do it anyway.
This is the start of a trend. Yeah, Tom's going to do it anyway. If this is the start of a trend, then it is some good news for the Fed in the sense. Tom's whispering over there, in the sense that they're seeing what they want to see. They don't want to see people lose jobs, but they expect the labor market to weaken.
Where's the number for you in your head? I'm looking at a fancy chart here, 2 standard deviations out. We had pandemic slide in 2021, massively range bound, and now for the second time, we've breached 2 standard deviations up. Is it a jump condition? No, but at 261, we're getting there. Where's the number in your head where things change?
I don't know if necessarily there is one, because the jobless claims are riddled with problems, which we discovered during the overall pandemic, but significantly higher, somewhere closer to 300,000. I suppose you would start saying it is moving in that direction. The question is this a one-off, as we saw the last time we went up big, or is this the start of a trend?
Lift to the equity markets here, fractionally, I should say, out of red. The yield space moves in. It's a churn, I'm going to say again, on yields. Dollar weaker fractionally. What else, Lisa? What do you say?
I will just say that, Mike said you can't really make a call on the Fed with one report. And yet, essentially, that's what people are kind of gaming out here in the market, that basically this takes the Fed, all things being equal, off the table. I mean, we could change that in 5 minutes, but that basically 2-year yields falling quite significantly, 5 basis points, not, to write home about, but you're seeing the dollar index hit intraday highs. You're seeing the euro gain considerably versus the dollar. So this is basically saying it takes some pressure off the Fed, and that is the big message from an upward revision to a jobless claim.
If you're going to look at anything, it does take the pressure off the Fed next week a little bit. We'll see what happens with CPI, but with these kind of numbers, it justifies them maybe not moving.
Michael McKee, thank you so much. Looking forward to inflation analysis next week. Joining us now is really one of the key calls within the Bloomberg surveillance world. It's rarely that you get somebody to give you a statistic or directional call and also throw a date on it. Matthew Lazzetti and the team led by Peter Hooper and David Fokerts-Landau at Deutsche Bank had the courage to do that a long, long time ago. They said there is going to be a slowdown, some form of NBER recession, but it's going to be out there. He nailed that call. We get an update this morning with Mr. Lazzetti. Okay, let's go to the timed element now. Which week, which day, which hour do we get a recession?
Yeah, that timing is always very difficult.
I'll let you go to a month. Give me the month.
We're still Q4. We updated our outlook this week, kept the recession timing in Q4. I think it's based on, we've seen the Fed tighten, obviously very aggressively. You've seen credit conditions tighten. You've seen some breadcrumbs within the labor market data of some softening. I'd be cautious about this morning's data just because there's a lot of volatility. There's seasonal adjustment issues. There's states that they're moving around. But if you look at last Friday's jobs report, it showed the permanent job losers really rising. And that's, I think, an important indicator. And then as you look forward for the consumer, you have excess savings dissipating by the end of the year. You have student debt payments coming back. And so we think it's a consumer that looks a lot weaker by the end of this year.
What gives you confidence, especially since people have been pushing out this date again and again and again?
Yeah, I don't think you want to express too much confidence on any particular month or quarter, to be honest. The labor market has proven to be more resilient. The consumer has proven to be more resilient. But I think, unfortunately, for the Fed, so has inflation. And that was kind of our expectation as you go back to last year. It was that the labor market was strong. It was that the consumer was strong. And then, therefore, inflation was going to be more persistent and the Fed would have to move more aggressively. I think looking ahead, I think the Fed skips next week, barring a big upside surprise to CPI. But I also think that they tee up a rate hike over the next several meetings. We think that comes in July.
If they skip, if they go through with that kind of shift, do you expect a meaningful move up in longer-term yields? Or basically, people say, maybe this is a sign that this Federal Reserve is willing to accept inflation that is a 2-point something over the longer term.
Yeah, I think that's the worry from their perspective, that you get this upward shift in inflation expectations because the market interprets it as they are losing some of their credibility or commitment to that 2% objective. And so I think they will want to do anything to push back or kind of tone that down, that notion. I think even from the doves you've heard, they want to skip, but they want to be very clear that this is not the peak of the tightening cycle, that there's very likely the potential for more rate hikes to come.
We've given short shrift this week to the crew, including Ed Hyman at Evercore ISI, who say, look, we're going to disinflate. With clarity in your note, and again, you've got the courage to put a date on it, year-end 2024, December of 2024, some kind of sub-3% inflation. How does our world change with, say, 2.65% inflation?
I think it's all about how you get to there. We, for our forecast at the end of next year, are down at 2.25% core PCE. So it looks like the Fed is very close to their
pricing that in right now.
Well, I think it depends on how you get there. Now, if it's an immaculate disinflation where the labor market stays where it is, then that's kind of a fantastic outcome for the economy, for markets. If it's a recession that is needed to get you there, that it's a labor market that very much needs to weaken, I think it's a very different dynamic. The Fed, I think their own forecasts have shown a need for some recession and rising unemployment. It's clear that the staff over the past several meetings have come to that conclusion as well. We still hold that view, that they really do need this economy to slow materially, the labor market to weaken to get closer to 2%.
And the legacy of Deutsche Bank analysis, this even goes back to Adam Szymanski and oil years ago, is always think dynamics. So I've got wage growth coming down, but I've got inflation screaming down to 2.x%. Can we have a quote-unquote Lazzetti recession with actual real wage stability or real wage growth?
I think what you will see is that wages will come down materially as the labor market weakens. And that is, I think, part of the Fed's game plan. They talk about, wages being a very important input into that core services, X-shelter component. We think it's an important, overall labor market is an important input into rental inflation. So to get back to 2% sustainably, I think you need a softer labor market, and the Fed needs wage growth to come down closer to that metric that Chair Powell cites of 3%.
Do you think that if they go again in July, assuming they skip next week, that the Fed is done after that?
I think there's still upside risks. We have been, I think everybody has been consistently surprised, and those surprises have all been in one direction, which is inflation stickier, labor market stronger, consumer a bit more resilient than anticipated. And so you don't want to discount the kind of serial correlation in those surprises. Could we get more? I think it's certainly possible, which could push the Fed to raise rates.
Raise rates beyond, beyond 5.5%. I'm just wondering, though, from your perspective, as we head into this mid-year point and everybody writes their mid-year outlooks, whether there's anything that you're kind of changing, shifting, second-guessing from the first half that you think will be a driving theme heading into the next 6 months?
Yeah, for us, it's definitely the potential that this cycle takes a little bit longer to play out, and that therefore the recession doesn't come by the end of this year, but a little bit later. I think for us, the key has been that we've pushed back the timing of rate cuts. We're now in March of next year, in part because the unemployment rate takes a bit longer to get there. I think just one important counterfactual here is that if we had not had these banking stresses emerge, it looked likely that the Fed was going to raise rates by 50 basis points in March. And having done that, I think they probably would have done so in May. And so the counterfactual is we'd probably be 50 basis points higher on the Fed funds rate. Right. The key question for them is, are credit conditions tightening enough to offset that?
What's the counterfactual of China? Do they export disinflation, even outright deflation? What do they do? The struggles they seem to be having, how does that change the American model?
Certainly the global growth impulse that people are expecting from China is seemingly not there as much as anticipated. I think the real concern from an inflation perspective in the U.S., however, has been that not only is services elevated, we've seen core goods inflation over the past 3 or 4 months also bounce back. Now, last month was all about used cars, so you want to discount that a little bit, but go back 3 or 4 months before that, it was broad-based. It was household furnishings, It was medical goods, and so there's, even in that category that we have the most confidence that you're going to get this big disinflationary impulse.
Tell me you're not walking back to the office.
I am, actually.
Come on, it's like deadly out there.
Do you have a mask? And
I do have a mask. And you guys have some down in the lobby, so I will.
You're taking one of Mike's last masks.
I brought one for myself.
So I'm going to go out there and die today.
I'll leave one for you. I'll take
one for you. Matt Lazzetti walking across Central Park. Matt, what do you call the building?
The Deutsche Bank Center.
The Time Warner Center. CNN Deutsche Bank Center.
Just the Deutsche Bank Center.
Very exciting. Well, we will do something over there sometime here. Mr. Lazzetti is with Deutsche Bank. But that's really what's come down to, Lisa, is like, okay, should the kids walk 5 blocks? And I'm like, I don't know. They're healthy, but still.
They're healthy and they're still coughing.
Stuff.
They still come back with burning nostrils and they fall on the couch and just go to sleep.
First time I went to Beijing, I was ensconced in the St. Regis. Life is tough. So they got me a car to go to the office. I said, oh, no, I don't need a car. I'm like Matt Lazzetti. I can walk. It took me 6 hours for my brain to recover from the pollution and the walk. 6 hours. I sat there in the office with a screaming headache.
So I'm going to blame that tomorrow when I come in. It's just taking too long to recover from the smog. That's the reason why my mind's just not picking up clearly.
Well, get the surveillance Bentley to take you home tomorrow. That's all there is to it. Green and red on the screen. Claims higher. No question about that. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Some 230 square miles of Ukraine's southern Kherson region is underwater 2 days after the destruction of the Kakhovka Dam. Now, the regional governor says almost a third of the flood zone, where thousands are being evacuated, is held by Ukrainian forces, while the rest is in Russian-occupied territory. Kyiv is assessing the humanitarian, economic, and ecological damage of the disaster that Western leaders denounced as a war crime. Michel Barnier, former EU chief Brexit negotiator and author of My Secret Brexit Diary, offered some insight into the post-Brexit landscape for the UK and EU. He spoke earlier with Bloomberg.
As far as trade is concerned, at the end of the road or at the beginning of the road, there is an economic reality. We are now in two separate markets, UK and EU. And the reality is that the EU market, single market, count 450 million consumers and citizens, 22 million business. That is the reality. And if you are on the side of the US or China or India, they know this reality.
The UK Prime Minister met with US business leaders and politicians ahead of a visit to the White House to see President Joe Biden today. And House Speaker Kevin McCarthy called off votes for the remainder of the week and sent lawmakers home. A revolt by Republican hardliners halted business in the chamber for a second day. The blockade by a band of 11 ultra-conservatives heightened tensions among Republicans following the Speaker's backing of a compromise with the White House to avert a U.S. debt default. The Speaker says he was blindsided by the revolt. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From the Wizards and Capitals to new ventures and innovative investment, running a sports empire in Washington, D.C. is a monumental task. Owner Ted Leonsis trusts CFO Peter Bichet to execute monumental sports and entertainment's financial game plan.
We are definitely in growth mode. What else can we do? How do we grow the platform?
Watch Chief Future Officer, Wednesday on Bloomberg. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
I think getting together is the best thing for golf. This fight that was going on and the lawsuits that were raging, and one side, the golfers from LIV, and taking shots at the PGA and vice versa, that's not constructive for the game.
Henry Kravis, really quite heated yesterday. Really interesting conversation with Jason Kelly here. Bloomberg Invest, Mr. Druckenmiller darkened the door yesterday. And there's Ann Maletti I saw walk by with Allspring in Milwaukee. And I'll be with Nassim Taleb here, I believe, in the 10 o'clock hour. Really interesting. I tried to make it a 2-hour conversation, and that got vetoed. But I don't know. We'll have a good conversation with Nassim Taleb. See if we're fooled by randomness. He's got a new book out. I'll sell it to you one more time on radio, Chaos Kings. This is very important. Scott Patterson writing this up with all his work at the Journal, and it's a really, really extraordinary book. On golf now, it would pay to talk to somebody that actually understands sport. John Garamendi is a Democrat from Sacramento, but far more than that, he's someone at Berkeley who was second-team All-American in football. He is someone that had a legit football prospect with the Dallas Cowboys and the Oakland Raiders. And he said, no, I'm going to go over to the Peace Corps with the love of my life to Ethiopia. And that was the end of his football career. He did so well in California politics, lieutenant governor, of course, insurance commissioner, and joins us here on the combat of modern sport. John, I can imagine the Saudis wanting to buy the Dallas Cowboys or something like it. Compare your analysis of this golf transaction, regulation, and monopoly with the shock if the Saudis or someone wanted to buy the Dallas Cowboys.
Well, actually, that kind of thing has happened in the soccer leagues of the world. The super wealthy, some of them from the Middle East, do own one of the key soccer teams in Europe. So yes, it does happen, but this situation in golf is really unparalleled. What has happened is that the leagues, the PGA League and the European leagues, have formed a monopoly, and they do not pay American taxes. So they can come into the United States, make billions, which certainly the PGA already has at least $1.5 billion annual revenue, and it considers itself a charity and does not pay corporate or any taxes at all. So we're going to end that piece of it. With regard to the monopoly, if I were a professional, wanted to be a professional golfer, I have no choice now but to bend my knee to this new monopoly. And if I wanted to sell golf clubs or I had a golf course, I've only got one choice. I'm going to have to take whatever they offer to me.
Gauge the bipartisan support. What's so different about Garamendi, folks, is he's been in the depths as insurance commissioner in California. Trust me, it's the worst job in California. So, John, explain to me how you're going to garner bipartisan support against the lobbying of the golf people, but frankly, the lobbying of football, basketball, hockey, and the rest.
Well, hockey, basketball, and the rest did have the same exemption. But over the years, beginning almost a decade and a half ago, those exemptions were eliminated, and they do pay taxes based on their net income. So there's only one left, and that's the PGA. It considers itself to be a charity, does not pay taxes on their income. They're exempt from corporate taxation. We're going to end that. I think we got a real good shot at it. Interestingly, in the 2017 Trump Republican tax cut, this tax exemption in the early drafts of that bill was there to be eliminated. A fellow whose initials were, JN, contacted the president or somebody in Congress and said, oh, no, you can't do away with the tax exemption. And it was removed in the final version of the 2017 tax bill. It's been floating around for a long while, the elimination of this exemption. My staff, one of my legislative staff guy, he wakes up in the middle of the night and tries to identify the worst, grossest tax loopholes. And this was on his list.
Yeah.
He pulled it out yesterday and said, why don't we run with this and eliminate this gross tax loophole?
Congressman, there's a larger issue here as well when it comes to U.S. relations with the Middle East, with some of the areas that are trying to plow into a lot of the major sport that people really depend on, including golf. I'm wondering how much pushback you're getting from within your own party, especially at a time when Tony Blinken right now is meeting over in Riyadh with MBS, trying to work out some peace deal. How much are people unwilling to really poke the bear in this particular instance?
Well, we ought to do more than poke the bear. It really, really angers me that we are forced to bend our knee to MBS, to Saudi Arabia, that has the worst human rights record perhaps in the world, and we know has assassinated and then hacked up a journalist who was critical of Saudi Arabia. We should never, ever put ourselves in a position of being subservient to anybody, and certainly not to Saudi Arabia. Now, just keep in mind, they've stuck the United States and really the world with an increase in petroleum prices just in the last week. They decided to cut their production, the result of which is America is going to wind up paying more for the gasoline and fuel that we consume. At the same time, this merger is going to give Saudi Arabia access to the American market, access to American money, and not have to pay taxes. That just really pisses me off.
Well, I wonder though, and to your point, how much you have support from other members of the Congress at a time when they don't want necessarily OPEC Plus making another cut. They don't want a continuation of these cuts. They don't want oil prices to keep going up. How do they sort of gain leverage at a time where they might be equally angered as you, but might have these other interests as well?
Well, let's put it this way. If Saudi Arabia thinks it can come to America, run a business in America, and not pay taxes, something is seriously wrong with that equation. And that's exactly where the situation is today. And we as Americans ought to say, yeah, fine. If you like this merger, I do not, but if you like this merger, then go ahead. But by God, you're part of this system, then you're going to pay taxes. And that's that. You're not a charity by any stretch of the imagination. And this loophole, this gross tax loophole, simply has to end.
Congressman, 10 years ago or so, you decided that the nation had to honor a golfer named Jack Nicklaus. You put in legislation in the House. I'm not sure quite how it came out, but I want you to comment on a time past of Garamendi on Palmer, Nicklaus, and the sportsmanship that's out there. I saw that at Oak Hill at the PGA tournament of a couple weeks ago. It sounds like because of greed and money, we're blowing up what we knew. What can your shop on Capitol Hill do to get out front of this?
Well, there are two specific issues in play here. One is the tax loophole, which my legislation would close, and this new monopoly would then have to pay corporate taxes, as would any other corporation, and that raises a whole other question about American corporations that do not pay taxes, but we'll let that go for a while. The other issue is one of competition, and what has been created here is an international monopoly on professional golf. That raises very, very serious questions of competition or no competition. As I said at the outset here, if I wanted to be a professional golfer, I could have chosen to play golf in Europe or in the United States or in this new league. Now I have but one choice. I'm going to have to take whatever this new league offers me, and I have no negotiation opportunity. Similarly, if I have a golf course, I don't know, call it Bedminster, Trump's golf course. He could have gone and negotiated with two different leagues for the use of his golf course. Now he's going to take whatever they offer him. He has no choice. So there's a monopoly issue here, and I would expect Congress to take that up, and if we don't, certainly the European Union should.
Congressman, thank you so much. The gentleman from Sacramento, the Democrat, John Garamendi, they're All-American football at Berkeley as well. I'm sorry, these guys talk differently. If they've done legit college sports or even pro sports, Lisa, they don't talk about the sports talk the same way mere mortals like you and I do.
Curious to see how much support he gets for this, whether this actually does become some sort of talking point.
And as you mentioned, I'm glad you brought it up. You mentioned the horrific issue with the Washington Post individual in Saudi Arabia, and that's got to be a huge part of the dialogue. It is an interesting morning as well. Markets want to lift. They're sort of red and green on the screen right now. The 10-year yield was in substantially earlier, 3.79%. Stay with us. Nassim Taleb in the 10 o'clock hour. Good morning.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open
for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do? Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Live from New York City this morning. Good morning, good morning. What a 24 hours, whipsawed by surprise rate hikes and soft economic data this morning stateside. Equity futures right now just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, global bond market shaken by surprise rate hikes. Druckenmiller, Dalio warning the pain is coming as jobless claims surge to new highs for the year. We begin with the big issue. Blame Canada for the smog and for the bond market volatility too. A second surprise rate hike this week. First Australia, then Canada's central bank following with an increase of its own, stating that monetary policy was not sufficiently restrictive to bring supply and demand into balance. The latest move coming after Canada signalled a conditional pause back in January. Sound familiar? Jim Reed of Deutsche Bank says the big question now is whether the Fed might follow up with a hike of their own next Wednesday, or whether they'll finally keep rates on hold after 10 consecutive increases. The move this week running counter to the widely held view that central banks are just about done. City's economists, who correctly called for a rate hike yesterday, are predicting for more of the same next week. Andrew Hollenhorst saying the surprise nature of hikes shows that once it becomes clear policy rates are not sufficiently restrictive, our base case remains for a 25 basis point rate hike next week from the Fed. The Fed's next meeting just 6 days away. Joining us now to discuss Morgan Stanley's Seth Carpenter, Colin Martin and Charles Schwab. Gents, it's Blame Canada Day. Indulge me. Seth, we won't talk about the smog, we'll talk about the rate hikes. Based on the information we've had this morning, claims a whole lot softer, surging into next week. Is the base case for you and the team no change?
So the base case still is no change. And just to defend Canada a little bit, my mother grew up in Nova Scotia, so I feel a little bit of responsibility there. No, the base case is still no change, but I hasten to add it is data dependent. So we have a forecast for the CPI release coming out on Tuesday to be 3/10 on core CPI. Continued progress on the key components of inflation that the Fed cares about. And if we get that, then I think we're still very comfortable with our call for there being no hike next week. But as always, it's data dependent. And I think everyone should have realized when the Bank of Canada said it's a conditional pause, what is it conditional on? It's conditional on how the data evolve over time.
Colin, what's your call?
I agree with Seth. I think the key point with Canada is that conditional pause. They hiked. They told us that they're going to wait and see what happens. And then we heard from them yesterday that they thought that policy wasn't restricted enough to slow things down. I think that's the same approach the Fed is going to take. They're not going to change their plans next week based on what other central banks are doing. They're going to look at the data that's coming in. We did get somewhat of a softer reading today, although that's just one data point. So we're going to need to see a few more prints like that before we get proof that there is more of a slowdown coming. But I think it does come down to the inflation outlook. Disinflation came a little bit and it's kind of stalled, and the Fed wants to see how that progresses. So we don't expect a hike next week. We actually think the odds of a hike in July are a bit lower than what the markets are expecting. But at the end of the day, the door is open, and this is giving them time to really evaluate how their policy is rippling through the markets and what it means going forward.
Colin, let's talk about that statement from Governor Tiff Macklem, that line that monetary policy was not sufficiently restrictive. People are starting to imagine that maybe that line might be in the Fed's future. Is it more likely than not that if they pause, take a skip at the next meeting, they'll be hiking again later this summer?
It's certainly possible. I mean, we've heard that. We know Bullard's talked about that, where he acknowledged that we just got to a level that's restrictive, where other Fed officials are kind of in various camps. But it does remain to be seen how restrictive policy is right now. Yes, in an absolute term, Fed funds rate over 5%, it's the highest we've seen in a long time. We think it should be restrictive, but if we look at what's happening with the economy, especially with a lot of the hard data, plenty of surveys are telling us that things should slow down. But when we look at consumption trends and spending trends, and then especially with the labor market, which may be starting to loosen, but is still admittedly tight, maybe it's not restrictive enough. So I think that's going to be a key point. But we're still in the camp that there is a lag with all of these rate hikes. And over time, all of those survey-based sentiment measures that we're looking at, we do think that that should ultimately lead to slightly slower economic growth and then a downward trend in that disinflation.
Seth, I remember a note you put out post-SVB failure, I think it was in late March, about the difficulty of calibrating policy appropriately for the situation we were in, particularly after the stress we'd seen in the financial system. Has that got easier? Got harder?
No, I don't.
Which one?
I don't think it's got any easier at all. We may have to have different people on the show because Colin and I are very much in alignment at this point. It remains to be seen. There are lags of policy. I think everything that happened with the banking sector reveals the need for the Fed to assess over time just how much restraint is being imparted on the economy. Our forecast is that not only are they not hiking next week, they're also not going to hike in July. But I will go back one more time to say it is a conditional forecast, conditional on us getting the data forecast right, with inflation continuing to trend down and a bit more softening in the labor market.
Seth, do they have the luxury of being wrong? The reason I ask that is if they are wrong and it takes longer for this to get back towards target, do you think there's a window here, a risk that it becomes more embedded? Do you have a window where you have to deal with this before that risk materializes?
I mean, I think the fact everyone has to accept is that everyone is going to be wrong, including the Fed. The question is how much and in which direction. In the context of whether or not inflation expectations, for example, will become unanchored, whether this inflationary process becomes embedded, I personally don't think so. At least there's no evidence of that yet. If we look at survey measures, if we look at break-evens, it does look as if in the longer run, inflation expectations are still under control. I don't think they, by any stretch of the imagination, want to take that fact for granted. But, again, as Colin said, we've got the funds rate up over 500 basis points from where we started. The balance sheet is still running off. It is hard to imagine that anyone would conclude that the Fed has just thrown in the towel on inflation at this point.
Hard to get a read on the economic data at the moment, Seth. Jobless claims were lower. There were distortions associated with the data coming out of certain states, and now they're higher again, and we're wondering whether there are distortions associated with certain states all over again. Seth, how would you read that surge in claims this morning?
I would read it as 1 week worth of data that goes in the direction of being softer, but by no means would I change my overall view on the economy based on that one data point. It's just too noisy.
Put it together with the jobs report on Friday, Colin. What kind of state is this labour market in?
It still seems pretty tight right now. I'll joke and go to a point Seth made. You probably booked the wrong people here. We're in total agreement right now.
I'll start disagreeing with you both
this morning. The jobless claims number this morning is just one claim, but we would expect it to start trickling higher. That's been the kind of the mismatch we've seen that has admittedly been longer than we've expected. We've seen all these headlines that started with tech companies, also then kind of trickled into the financial sector of layoffs. And then we weren't seeing it in the initial jobless claims data, nor were we seeing it in the payrolls data. Maybe we start to see that trickle in as these lags come through and as time passes. At the end of the day, the labor market does appear to be relatively strong. We did get that jump in the unemployment rate at the previous jobs report release. But I think that's going to be important to watch as we look at the next month or even two. Luckily, we'll get one more before the next Fed meeting to see what that household survey did, what do non-farm payrolls look like, and does the unemployment rate continue to rise? Because if I think it does continue to rise, even if it's by a 1/10 or so, that supports the case for the Fed to pause and really see what's going to happen over the next handful of quarters.
Seth, I've had a lot of questions, people running in about the labour market report from last Friday, the establishment survey, which goes into payrolls, the household survey, which goes into the unemployment rate. Seth, how were you explaining that to clients?
It's a little bit of a head scratcher. It went against our forecast. And so what I never want to do is sort of cherry pick only the parts that go in the direction of our forecast. I mean, it's just an empirical fact that the household survey tends to be more noisy than the payroll, than the establishment survey. And so I think you have to admit that there's some strength there. Nevertheless, what we know as a fact over the past year or so is that the amount of payrolls in the economy relative to the amount of GDP, the amount of economic activity, the economy is still shorthanded. So part of the strength in the hiring, part of the strength in last week's jobs report, I think reflects the fact that businesses know they're still shorthanded and they're making up a little bit for lost time. So I think you can discount just a little bit that strength, but boy, it was an upside surprise.
Seth, it's so confusing for so many people. I'd like to fold in as well what's happening with housing too. I'll read into the equity market and you can give me the economics perspective to this as well. The home builders on the S&P 500 are up by close to 80% from the lows of almost 12 months ago in the middle of June last year. Seth, that's maybe going against the grain a little bit in the equity market. Seth, can you explain that, the economics of that? What is going on with housing with rates at 5% and mortgage rates potentially through 7%?
One of the points I do like to make to clients all the time is that the equity market is not the economy, at least especially not sort of at any point in time. And so what did we see in actual economic activity in the housing market? Housing starts fell, and they fell like a stone. They have stopped falling, right? They maybe have turned up a little bit, but in levels terms, they're still quite low. Now, the equity market saw all of that coming. We saw a rise in interest rates. We know from history that that kind of rise in interest rates is going to lead to a drop in economic activity. So the market got ahead of all of that, priced things down for home builders a year ago. And now that we've seen, presumably, the bottom, markets are starting to look forward through time and saying, okay, we still know that, for instance, people who have 30-year mortgages, they're locked in. They're not going to be selling their homes. So a larger proportion than normal of any home sales are going to come from new homes, because people who are living in their homes aren't going to sell unless they have to. And I think that's part of what squares that seeming tension between the still weak levels of housing starts against what we're seeing for home builder stocks.
Seth Collin, in agreement, you're going to be sticking with us. Coming off of the programme a little bit later, we'll continue this conversation. Let's just get into the market just a little bit. We're just about negative on the S&P 500 at the moment with some movers. Here's Abby.
John, we'll be taking a look at two of the stocks that are dragging on indexes. But first, let's start off with a winner. That is Adobe. Shares are popping, although maybe not quite as much as you would expect, given the fact that AI is a part of the headline. They're launching subscriptions for new generative AI features that will include copyright protection. The stock up 1.7%. Signet Jewelers down 10.4%, well off its lows, but nonetheless, they slashed their annual outlook. The fiscal 2024 is now between $7.1 billion and $7.3 billion in sales. They're seeing fewer engagements, and they're also seeing couples choose cheaper engagement rings. GameStop plunging down 23%. Matt Furlong is out. Ryan Cohen is in as CEO. They missed sales by more than 7%. A narrower loss, and Cohen, of course, Ryan Cohen owns 12%. It's going to be interesting to see how this company has potentially changed.
Abby, thank you. More on some of that around the opening bell. Coming up, legendary investors weighing in on that elusive recession.
Since it's taken so long, the Fed has ended up with a higher terminal rate. And in fact, inflation gets stickier the longer it stays in the system. that it increases, not decreases, the probability of a hard landing.
Right now, building on that, Shanali Basak catching up with John Waldron of Goldman Sachs, saying that this recession is the best predicted recession that hasn't happened yet and may not happen. That conversation still ahead.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
In no way does the fact that it hasn't started yet change the probability of whether it's going to be hard or soft. I would actually argue, since it's taken so long, the Fed has ended up with a higher terminal rate. And in fact, inflation gets stickier the longer it stays in the system, that it increases, not decreases, the probability of a hard landing.
Famed investor Stanley Druckenmiller remaining pessimistic on the US economy. Ray Dalio delivering a warning of his own.
We are at the beginning of a very classic late big cycle debt crisis, when the supply-demand gap, when you're producing too much debt, and you have also a shortage of buyers.
Seth Carpenter, Colin Martin back with us. Colin, you get to go first on this one. That warning from Ray Dalio there on the debt market, you're in fixed income. What do you think when you hear that?
Well, that was a pretty dire warning, but we think that the debt market is still in pretty good shape. And if we look at where yields are right now, we still think it's an opportunity. So I don't have the full context of his comments there, but when we're talking to clients, that's not the message we're relaying. Although admittedly, we do get that sometimes, because when you hear snippets like that, we hear clients concerned about a debt bubble or something like that. At the end of the day, we're not concerned about that. What we focus on is, well, one, the safety of the Treasury market, but then also the yields they offer. This is something that's been talked about every day on all these programs for the past number of months, the attractive yields that are out there. What we're finding is that our clients are still generally sitting in very short-term investments, and it's hard to blame them, because Treasury yields of 5% or more are attractive. They're at the highest levels we've seen in years. but we're still trying to get them to get their feet wet a little bit with some more intermediate or long-term bonds where you're taking out some of that reinvestment risk should the Fed have to cut rates down the road and some of the uncertainty. And it's a tough message to get out there, and it's a tough pill to swallow when you see such attractive short-term rates. But we're continuing to provide that guidance and suggest our investors move out a little bit and lock in yields of 3.5%, 4% or more with very high-quality investments with slightly longer maturities.
Colin, Tom and I are calling that a cash trap, that once you get in, it's much harder to get back out. Do you see some reinvestment risk on the horizon then? People that have gone into T-bills now, that when they come out the other side, those yields won't be available anymore?
Absolutely. I mean, that's the huge risk that we're talking about, but it does seem like that risk might be pushed back a little bit. I mean, we're not in the camp that the Fed necessarily is going to cut rates anytime soon. We still disagree with the pricing we see in the market where the Fed funds futures is implying a rate hike by July and then a rate cut just a few months later. We don't really subscribe to that theory where we think the Fed can hold and pause for a long time. But at the end of the day, we do expect a rate cut to come because the Fed will likely need to because of the negative consequences of the restrictive policy that we see right now. And we don't want our investors or any investors to be caught wrong-footed like that and be tempted with a 5% yield now only to see 4, 3.5, 3% at some point down the road when you can lock in higher yields with certainty. So that's been our main message. It continues to be our message. It does seem like maybe reinvestment risk has been pushed back a little bit, but it's still very much present.
Seth, finally, we call it here the 3-month rolling recession forecast. We just kind of keep pushing it out a couple of months. Every single month, it's 3 months away. Seth, any reason to believe it comes anytime soon? And where are you and the team now for that first cut?
Yeah, so for the first cut from our perspective, that's not until March of next year, March of 2024. We don't have a recession in our forecast as a baseline scenario. Slowing growth this year for sure. And in fact, if the economy is proving to be more resilient than people think, then the Fed's just going to have to do more in order to slow things down to get inflation down over time. But we're reasonably comfortable with our forecast now. We think that we'll get further slowing, but not a recession this year, not a recession next year.
Seth Carpenter, Colin Martin, to the two of you. Even though you agreed, I enjoyed it. It's great to get your perspective from the both of you on what's happening right now. Is it a recession that we can avoid? Right now happening at the Bloomberg Invest Conference, Goldman Sachs' president, COO, John Waldron, sitting down with Bloomberg's Sonali Basak on that very topic. John Waldron, a little bit earlier in the conversation, saying this might be a recession that we can avoid altogether. Let's listen in.
Value what we're doing, but I would say a couple things. First, we have two very big, very scaled businesses that we feel great about. One, global banking and markets, which is a $30 billion plus minus revenue business that generates mid-teens returns, that is a leading client franchise all over the world in banking type activities and in market type activities. And we've increasingly run that business in an integrated fashion, particularly focused on financing our clients, where we think there's an enormous opportunity. We talked about the environment. One of the things I didn't say that I probably should have said, and we feel strongly, the financing environment in the economy is going to get tougher. It's going to be higher cost to finance. It's going to be less available than it was. Financing was quite plentiful. It's going to get more complicated. Goldman Sachs is very well positioned to be a more prominent financier for our clients. And by running the global banking and markets businesses now in an integrated fashion, we think we're bringing all that intellectual capital and throw weight together to be more valuable to our clients. So we love that business. We think that business is going to continue to produce mid-teens returns through the cycle. And there's obviously growth and opportunity for us to continue to take share. We've proven we can take share. The second primary scale business in the firm, as you said, is called Asset and Wealth Management. That is a business that is an aggregation of a bunch of businesses that we had inside the firm that we've now brought together into an integrated platform. It's really three primary components. There's a liquid active asset manager with $2.7 trillion of assets under supervision on that platform. Top 5 active asset manager in the world, very global, runs the gamut from a product solution standpoint, from cash and money markets through fixed income, fundamental equity, quant, and all the way through to the riskier end of the spectrum. So it's a fully integrated, fully scaled platform. We have a top 5 alternatives asset manager with $450 billion or so of alternatives assets, which also is a hugely fully scaled platform, very global. And then we have a wealth management business, which focuses primarily on the ultra high net worth segment, which are the wealthiest individuals and families in the world. That business has $1 trillion of client assets on the platform. It focuses on, as I said, the wealthier families, but we're only an 8% share in the Americas, if you take the Americas broadly as a category. So there's a lot of fragmentation in that marketplace. We've been at that a long time. We continue to grow that business mid to high single digits, and we think there's an enormous amount of runway there. We also think there's a lot of runway internationally in Europe and Asia as we continue to build our platform globally. So those three businesses now run on one integrated platform. We're spending a lot of time in terms of tech transformation to build a more unified chassis, as I would call it, that underpins those three businesses. So we have a scaled institutional client base. We have a scaled wealth management client base. We have public market capability. We have private market capability. And we have an integrated platform that is increasingly tech forward and much more digital and much more scalable. And so that business for us is under transformation. We have historically pursued the alternatives business with more of our own capital in a more merchant banking-oriented fashion. So Goldman Sachs, unlike a Blackstone or a KKR, would have had a lot more of our own balance sheet invested in our alternatives assets. We have, over the last 4 years, transitioned that balance sheet from $60+ billion of historical principal investments on the balance sheet to less than $30 billion on the balance sheet. And we've stated a goal to get it down below $15 billion by the end of 2024. And to zero in the intermediate term, and we'll end up with $20 billion or so of co-investment in our funds. So every dollar we have on the platform from our balance sheet will be aligned 100% co-invested in the funds with our clients. That is a very unique scaled platform that we have to make work, and we have to prove the synergy in the context of that business. But that is also a business that we think can be a mid-teens business through the cycle. So Goldman Sachs, in a handful of years, is going to have a mid-teens global banking and markets business and a mid-teens asset and wealth management business at scale with a lot of growth opportunity, where we're going to be more management fee intensive than we have been, much less balance sheet, much more balance sheet light, with an enormous opportunity to grow a great brand, a globally scaled business, and a lot of talent. And so that is the story of Goldman Sachs, and we've got to now go execute on that.
What does this mean? Because you just kind of highlighted one part of Goldman Sachs looks a lot like KKR and Apollo, just one part, right? And so how big does that alternative asset manager get within Goldman Sachs? And how does it fit with the other businesses, for example, with investment banking, with those folks being some of your biggest clients?
It's a good question. I mean, I have watched the growth of alternative assets with awe, frankly. And I've spent a lot of my career in and around alternative assets. I was doing private equity deals for those companies and other clients of the firm, 20-some years ago. The scale of these firms is extraordinary, and they continue to grow and take share, if you will, of the asset aggregation in the world. And I don't see why that will change. I think that will continue. The growth rate might moderate a little bit. It's a little tougher fundraising environment today than it would have been a handful of years ago. But I think more clients want access to the aggregate return and the alpha opportunity in private assets. And private assets obviously runs the gamut from private equity to credit to infrastructure, growth, et cetera. And so Goldman Sachs for 30 years has been a leader in this business. We have just done it a little differently than would be the traditional private equity firms that have done it mostly with third-party funds. We've done it with our own capital. As I said, we're transitioning that. But we've got a few unique attributes. As you said, we have the largest investment bank and I think the leading investment bank in the world. That provides an enormous sourcing engine. We're sourcing transactions and ideas and introductions to CEOs and so forth for our clients and for our own team. And we're doing, I think, a very good job partnering with our clients. So the firms you mentioned and other firms, I could run off a litany of transactions where we've partnered with them, or we have an idea, we bring it to them and say, why don't you guys invest with us and we'll prosecute the idea together. So we've found a symbiotic relationship in the context of running this strategy. Our business with those firms, I think, has gotten better as we've pursued this strategy, but it takes a focus on partnering, doing what's right for our clients, and we can benefit along the way in that context, but it's got to come from the clients first.
Let's talk about talent for a moment here, because with James Gorman at Morgan Stanley saying he'll step down in a year, there's been a lot of focus on succession at Wall Street. David Solomon has been in the position for 5 years now. The question here, and frankly, you're the most clear successor. And so how long is David's tenure expected to be? And how are you thinking about building the bench even deeper at Goldman, especially with such high profile turnover, not just at Goldman, but in all of Wall Street?
Well, I'd say the following. CEO succession is not something I spend a lot of time on. I have a lot to do. I just outlined all the things we have to do. My job is to execute with our team, execute that strategy. So my days are full executing that strategy. We do spend a lot of time on succession below, let's say, the CEO or president or CFO level. I spend a lot of time running succession processes for our people below that level. And I think we've done a better job in the last 4 or 5 years, really trying to build a deeper succession pipeline and giving our talent, which I think is extraordinary, more opportunities to grow and develop, to move around, to get new job opportunities, new stretch assignments, and to continue to position them to be able to ascend to the kind of jobs that David and I sit in. And we have an extraordinary bench, but our job is to not just look at the bench and say, wow, it's really great. Our job is to work on that bench and that talent and that strength and do the right things to develop them. So that's what occupies my time and attention as it relates to succession.
Earlier in the conversation, you kind of talked about the potential for investment in AI and technology. Goldman was really at the forefront of really automating a lot of businesses. I remember Lloyd Blankfein once speaking at a conference about automating equities to the point of bringing a 500-person trading desk to one. Are you working on using AI to further automate some of the more difficult areas like fixed income trading or investment banking?
So we've been using AI for a while. And as you rightly point out to Lloyd's comments, our firm, I think, has been very forward-leaning on technology for a long time. And there's been lots of different developments and innovations that we've tried to be adaptive to. And I think we're, generally speaking, a leader in technology. We're not the only one, but we generally try to be pretty front-footed. And I think it's been very important for Goldman Sachs to continually find ways to use technology to advance our ability to serve our clients and also to make our firm more efficient. And generative AI, when I think, you say AI, we've been using AI. The real new development here are these large language models, the power and strength of these large language models and what they can do. And so when we think about generative AI, we really start, first of all, with let's build a governance standard and capability inside the firm so that when we do things with respect to generative AI, they're done in a way that we're very, very comfortable with, because I think governance is going to be critical. And then the second thing is to develop use cases that are valuable, interesting use cases for us to start to explore how we can use the generative AI to suit an objective. And I would put the use cases in 2 buckets. One is more efficiency, automation, process re-engineering inside the firm to make us more efficient, to do things that are very human-centric, to take things that are very human-centric and make them more automated and use some of the capability and power of the computing to simplify and make the processes more durable, more resilient, and better. The second bucket is really how can we serve our clients better and develop intellectual content and judgment on top of that intellectual content that can be more powerful and more valuable. And so we're looking at both, and we're starting to really test in a very safe, governed way some of these use cases and developing our strategy forward. It's very early.
John Waldron there of Goldman Sachs in conversation with Sonali Basak on AI, on all things banking, on recession. A little bit earlier in the conversation saying maybe we avoid that recession altogether. From New York City this morning, good morning. If you are just tuning into the program, seconds away from the opening bell with equity futures on the S&P 500, just about unchanged. There is your opening bell on the Nasdaq yesterday, biggest one-day drop going back to April. Struggling to bounce here. Get into the bond market. This bond market whipsawed, absolutely whipsawed in the last 24 hours. Yesterday, yields were higher off the back of a conversation about higher interest rates in Australia and then Canada. This morning, yields are lower at the front end by 4 or 5 basis points, on a 10-year by 2, off the back of some pretty dreadful economic data about 1 hour ago. Jobless claims surging to new highs for 2023. We'll see if that data is distorted or not. That's just 1 week. We'll wait for another one. And another one, and we'll see if this Fed takes a conditional pause, skips a hike at their next meeting, about 6 days away. Into the FX market, off the back of that data too, we show some dollar weakness here, some euro strength, 107.50 on the euro, positive on that currency pair by about 0.5%, and crude around about 0.36% higher, up by about 25 cents this morning to $72.80. Let's get to one stock on a move. Carvana in a big way. Shares getting a boost as the company says its Q2 EBITDA is expected to top $50 million. The CEO saying this: the first quarter was a big step in the right direction. It is clear our strategy is working, as evidenced by our 61% increase in gross profit per unit, the best Q1 figure in company history. Abby, that stock absolutely surging.
It is absolutely surging. But what's interesting here, John, there's so much volatility for the shares of Carvana that since the beginning of May, we have now seen, including today, this is the 8th move that's greater than 10%. And if it can get back above 20%, there it is. It's the 4th time we've seen this stock climb by 20% on a trading day. So again, lots of volatility here. A piece of that is the fact that the stock is down 95% from its all-time peak, and there's a 50% short interest. So lots of volatility. But for today's move, it is definitely fundamentally driven in terms of those results that you were just talking about. Better than expected. The used car retailer really putting up a net income that's stronger. They didn't give guidance for the net income, but their estimate for adjusted earnings of $50 million in this current quarter versus the estimate of $3.6 million of a loss, that's really a significant difference. Investors rewarding those shares at this point. Again, the stock is absolutely soaring right around that 20% up mark.
Amazing. Up 19% right now. Abby, thank you. Different story for GameStop. Shares extending its double-digit loss amid major C-suite changes. The retailer firing its CEO, Matt Furlong, and electing a new executive chairman. This coming on top of a weaker than expected Q1. Isabel Lee has more. Hey, Isabel.
Hi, John. It's definitely a 1-2 punch for GameStop. Shares were plunging as much as 22% in pre-market trading, and it's now lower by around 19%. And as you said, yes, the company reported net sales that missed estimates. And more importantly, it terminated Matt Furlong, its president and CEO of 2 years. The company announced that Ryan Cohen will serve as executive chairman effective immediately. And Cohen is the largest shareholder of the company with 12% of the stock. General counsel Matt Robinson will become general manager and principal executive officer. He will report to Cohen. So here's the interesting thing, John. GameStop called off its earnings, and Wall Street strategists aren't happy. We have Jefferies analysts saying it's difficult to have an opinion on results without a call. They also said the only thing consistent is management change. Baird also said the firm's turnaround plan seems similar to what it was before the NFT craze. So definitely lots of changes in GameStop.
Isabel, thank you. Carvana up almost 20%. GameStop there down almost 20%. Turning to tech, Lucid gearing up to enter the Chinese EV market. According to Reuters, the company is also said to be considering local production in the country. Their stock slightly higher by 3%. Ed Rudlow has more. Morning, Ed.
Yeah, good morning, Jonathan. Reuters referencing Lucid's China head Zhu Zhang in those comments that they intend to enter the Chinese market on an export basis. Vehicles built in Casa Grande, Arizona that would then be imports into the Chinese market. They cite an unnamed person familiar with the matter on the idea that Lucid is looking at local production. As you and I have discussed many times, there are many more players in the Chinese EV market and a much broader spectrum of product offering, from the very high end in which Lucid operates to much cheaper mass market models. I've been covering this company for years, and I remember all the way back in 2018-19, Peter Rawlinson, the CEO, talking about this idea, this distant idea of China being an opportunity, but at that time they had no concrete plans. We've reached out to Lucid for comment. They have not yet replied to confirm that that is their intention. It adds to recent news that they did a $3 billion offering, most of which will come from the Saudi Public Investment Fund, which already holds 60% of the company. And the narrative around Lucid is really, are we moving towards privatization? They have had so many production problems, never really got off the ground in terms of volume production, and have cut their full-year guidance a number of times over the last fiscal year or so. Because that high price point is one that everyone was watching with excitement. But again, they've struggled to really get to that scale production that others like Rivian, for example, have managed to do.
Ed, let's park that, put that to one side, and let's unpack the story you and I actually want to talk about.
Oh,
what do you make of that Lionel Messi deal? The potential that there could be a profit-sharing agreement with Apple?
I've been thinking about the MLS for some time, and Sun Valley's coming up, the Allen & Co conference. A year ago, one of the big stories was the tie-up between MLS and Apple TV. And you look at some of the reporting out there, the profit-sharing mechanism which Apple TV is involved in, is this lift-off now, a name like Lionel Messi? Gareth Bale, for example, didn't have that amplifying effect when he was at LAFC. Lionel Messi is probably a different category, right? But I think about the streaming rights. Apple TV made a big move to bring MLS to the international audience, not just the US audience. I wonder how many eyeballs it brings in, John, from a streaming perspective. You know that I want this league to get off the ground. I'm desperate for some real action, but I think it's going to be needle moving. More to life than money, football is life.
I agree. Ed Ludlow, thank you for that. That's why I wanted to go there. I'm looking forward to your coverage a little bit later on Bloomberg Technology. Caroline Hyde, Ed Ludlow coming up in about 2 hours and 25 minutes' time. Let's stick with tech. Adobe jumping on the AI bandwagon with a plan to offer subscription services. Katie Greifeld has more. Hey, Katie.
Hey, John, let's talk about what we're actually talking about for these subscriptions. So these are subscriptions for tools that will generate images from a prompt across Adobe products, including Photoshop, of course, one of their most popular products. And in addition, if a customer is sued for infringement, Adobe will pay damages and help in court. Now, this move got a lot of love from the sell side this morning. You had both Piper Sandler and Deutsche Bank raising their price targets on Adobe to $500. For context, currently we're around $432, give or take. So with Piper Sandler's Brent Bracelin, he specifically cited the company's, quote, accelerating pace of innovation that's evident by these new Gen AI features. Now, of the 41 analysts that track this company, there's 0 sell ratings, and you can see it's getting a lot of love from shareholders this morning, currently up about 3%. This company reports next week. It's going to be interesting to see how much of a hot topic AI is on that Adobe call.
Katie, thank you. That's the latest right now on Adobe. You've heard the warnings about narrow leadership.
A lot of the levers that drove mega cap tech to its, soaring weights in the S&P 500 have at least stalled, if not reversed. It's going to be a very stock-specific leadership cycle. So I think some big cap will do well, but others won't. I would be worried about mega cap tech and a lot of the sort of low interest rate beneficiary leadership in the market.
That's equities. What about credit? Amanda Lynham and the team over at BlackRock saying this: it's not all about technology in credit. While the sector has been a meaningful contributor in both investment grade and high yield, it pales in comparison to the equity market. Amanda Lynham joins us now for more. Amanda, always wonderful to catch up with you. Let's start there. The story that we see, narrow leadership in equity markets, do you see the same thing in credit?
Good morning, Jonathan. Thank you for having me. We don't see the same thing in the credit market, and that cuts across both ratings cohorts and regions. And as you alluded to in your previous segment, you were talking about how the equity market is not the economy. This is a great example of how the equity market is also not the credit market in many respects. We've had more broad-based participation from sectors in terms of contributing to total performance, or that breadth measure that we think is really important for capturing alpha. We've had more broad-based participation at the sector level in the credit market year to date versus for sure what you've seen in the S&P 500 compared to the equal weighted index in the equity market. I think that continues. And one of the really interesting things that we've seen is that it's somewhat easy to say, well, perhaps the total return contribution tracks the index weight in the credit market. We've seen sectors that were punching above their weight in the credit market, like energy, like leisure and lodging, like retail, in the high yield market in particular, that have really outperformed relative to what their index weight would suggest in terms of contributing to total return performance. And in this environment where dispersion is high, where we do expect an uptick in defaults as the cycle continues, we're expecting below trend growth, as you know, sticky inflation. We do not expect rate cuts. We expect a higher cost of capital environment. We think that dispersion will continue to drive alpha generation, but we hold on to this point that breadth is really important for total return contributions in credit, and we think that pattern will continue, unlike perhaps what we've seen year to date in the equity market.
Amanda, I want to talk about return potential in credit just a little bit more, because you're not the first person, you won't be the last. I've heard from a lot of people this week, from fixed income, throw cold water at what's been developing in equities. Mark Kiesel of PIMCO said this earlier this week to me. He said, we haven't seen this return potential in bonds in more than a decade. We don't think this yields will be there in a year from now. Amanda, just what is this setup like from your perspective? Can you describe it?
For sure. So I think, walking into this year, we did have and we still do have a really attractive opportunity across various subsets of fixed income, all in yields or at levels that we haven't seen in some cases over a decade. Again, the credit market is very nuanced, so it depends on what region and asset class you're looking at. But the point that we've made recently is that a lot of that heavy lifting in terms of getting yields, all in yields up to those very attractive levels, has been done by the risk-free rate. And in some areas, spreads are actually still quite snug. You know, the U.S. high yield market in particular is below the median of the post-financial crisis era and the past 2 decades. And so we think that it's reasonable to expect a rebuild of risk premia in some of these markets, so meaning spreads would go wider. And so that's something that we're definitely watching for. But to your point, it's a very attractive opportunity set in fixed income for especially all-in yield buyers. And we think that probably persists because, again, I think the bar for the Fed and other central banks, frankly, to cut rates is quite high, and we continue to have that view. And we're seeing it from central banks around the world, really, just because inflation is so persistently elevated. And I think it will take time for that to come down. The other point that I think we've been talking a lot with investors about has been how to diversify portfolios in the environment that we do have this higher for longer interest rate environment. And we're firmly in that camp. And we've been looking to alternative assets, specifically private debt, as a really good way for investors to capture some of that floating rate exposure, even though we may be very much towards the end of the rate hiking cycle, but still build in some of those structural protections that we think will be really important as we head towards a period of below trend growth, sticky inflation, restrictive monetary policy. So a really challenging growth, inflation, and policy mix with a higher cost of capital for an extended period of time added to that.
Amanda, is that below trend real GDP? And will nominal GDP continue to be quite high like it has been over the last couple of years? And with that in mind, how do you think about what that means for the performance of credit? Because if I speak to equity investors living in a nominal world, they like the idea that nominal GDP will stay high. Can I get your comments on that and what that means for credit?
For sure. Yeah, it's a great point. So I think the inflationary backdrop has boosted nominal earnings, but at the same time, you're also having inflationary pressures on the cost of goods sold, the cost of capital. And so that's something that investors are very mindful of. And on the corporate side, whether you're managing to your equity stakeholders or your credit stakeholders, you really do need to manage that kind of nominal growth in the costs that are eating through your margins. And what we've seen is that even the higher quality aspects of credit, so to your point on how that flows through, the higher quality rating buckets in the credit market haven't been immune to those pressures on margins. In fact, for various points of this year, whether you cut it by spreads or excess returns or total returns, the high end of the high yield market in some instances has been outperforming the low end of the IG market. And so it really just speaks to the point that your top line can get a boost from inflation, but at the end of the day, it's the bottom line profit that really matters. And that those inflationary pressures, specifically wages, but other parts of the expense line items as well, are really inflated because of that inflationary environment. And that's something that corporates are going to need to handle for an extended period of time. We're seeing it in the cost of capital, but then we're also seeing it in the regular way earnings. And I think it's been striking that the higher quality markets, parts of the market haven't been immune to that.
Interesting. Amanda, thank you. As always, great note, by the way. Really interesting read. Amanda Lanham there of BlackRock on the latest in credit, the leadership profile of credit versus, say, equities right now. Coming up, you've heard a lot about this, U.S. exceptionalism.
The economy is far more resilient, as you know, than is appreciated. What's actually driving the market is earnings expectations, which have generally been improving over the last few weeks.
That was Neil Dutta of Renmac. Do you remember the Europe story? The boom over in the Eurozone? Well, arguably, Europe was in a recession Q4, Q1, and now it's the return of exceptionalism in the United States of America. That conversation up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The economy is far more resilient, as you know, than is appreciated, and that's going to mean that the Fed's ultimately going to have to do more than what's priced. What's actually driving the market is earnings expectations, which have generally been improving over the last few weeks. Earnings are up, and that's why the market's up.
Neil Dasser of Renmax still optimistic. The latest comments adding to these just last week. The main reason for optimism on the U.S. economy is that inflation, especially prices for commodities, is easing more rapidly than the labor market. As a result, real incomes will expand, supporting consumption. So for some at least, the U.S. economic expansion remains on track despite constant calls for a recession. Meanwhile, in Europe, the Eurozone economy is suffering the mildest possible contraction. According to revised data for the 20-nation economy, shrinking 0.1% between January and March, adding to a fourth quarterly decline of the same magnitude and leading to the first six-month contraction since the pandemic. Let's get to the team coverage. Bloomberg's Mike McKee, Guy Johnson. Guy, straight to you. Are the Europeans calling this a recession or doing that US thing of the last 12 months and arguing about it?
This isn't a recession. Of course it's not a recession. Who cares, John, whether or not the economy was point up or point down? What does matter is that this was a period of stagnation, let's call it that, in which core inflation, John, either accelerated to the upside or was incredibly sticky. We had a mild recession and inflation didn't come down. Core inflation didn't come down. And that's the way to watch this. Yeah, we were down a touch, but it could have been significantly worse. We had the energy crisis that didn't turn up. We had fiscal policy that was very expansionary. So yes, the numbers could have been worse. We already know that. What is important about this number is that it coincides with a period of very strong inflation. What kind of a recession, therefore, are we going to need to bring inflation back down to target for the ECB?
Mike McKee, is that the smell of stagflation going into next week in the ECB?
Well, it certainly could be, but the question is, in the United States, how different are we from what's going on in Europe? Well, one thing is the central bank has a dual mandate, not just inflation, which is still double what they anticipate or would like to see in their mandate, but we also have an employment mandate. And we got some news this morning that suggests maybe some cracks in that. Jobless claims rise by 28,000, the biggest increase in some time, to 261,000. Is it a harbinger of what's coming in the labor market, or is it a one-off like the last time we saw a bit of a spike? That's going to be a question the Fed doesn't have an answer to, because the next claims numbers come out on Thursday of next week, and the meeting is Wednesday. we're also expecting to see some new projections from the Fed for growth and for unemployment and for inflation. Here's the latest Bloomberg economic survey. While we do have predictions for slowing growth, economists surveyed by Bloomberg, as you can see there, that white line, think we just won't go under the zero line, unlike the Europeans. But look at the bottom there. They're also predicting a 65% chance of recession. So on the one hand, they're predicting recession. On the other hand, they're saying we're not going to contract. I'm not sure anybody really knows what's going to happen here in the States.
Hey, Guy, you get the final word on what's going to happen over in Europe. The ECB set to hike next week. What's the what next from the ECB after that?
Well, the what next after that, probably, John, is another rate hike. Inflation is proving to be incredibly stubborn. To Mike's point, they have a single mandate. To use Jean-Claude Trichet's phrase, there is a single needle in the compass. They need to get inflation back down to target to retain credibility. It is not coming down. The economy is stagnating and it's not coming down. They need to push harder, seems to be the message. You get hearing it consistently across the board from most members of the Governing Council. So what next is another rate hike. The question is, do they then pause? And do we then end up in a scenario where they pause maybe for 1-2 meetings and then they have to come back, a bit like the Bank of Canada and a bit like the RBA? That is the challenge that I think central banks are dealing with right now, and they're watching very carefully what is happening elsewhere.
Agreed. That's the conversation of the last 24 hours in a much more pronounced, bigger way. Guy Johnson, Mike McKee, looking forward to the coverage with you guys a little bit later. Guy and Alex Steele coming up in about 7 or 8 minutes' time. Consensus trades this year. We've been talking about it on this show over the last few months, and just getting eaten alive. We came into 2023. We don't like tech. Tech ripped. We don't like the US dollar. The dollar over the last couple of months starting to show some strength. We think we're going to get rate cuts, then we have to price them out. We love Europe. We love Europe. Do you still love Europe? Let's get you some sector price action. Here's Abby.
Well, John, we're looking at a tiny loss for the S&P 500 at this point, but much bigger moves beneath the surface, especially to the downside. We have real estate down 1.6%. The financials down 0.75%. Materials, industrials both down more than 0.5%. To the upside, consumer discretionary and technology. So after yesterday's big sell-off, we have a little bit of a bounce back for the mega cap techs. Let's take a look at this rotation that we're seeing over the last week, because it is pretty interesting that you have small cap up 6%, helped out by the banks up by about the same amount, but the NASDAQ 100 and the SOX, well, they are both lower.
Abby, thanks for that. Coming up, your trading diary.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Bonds whipsawed over the last 24 hours, stuck between surprise rate hikes from the Central Bank of Canada, pushing yields higher by almost 8 basis points, About an hour and 25 minutes ago, jobless claims in America surging, pushing yields back down by about 7 basis points to the front end. Equities not doing much at all, down about 0.1%. That's the price action. Let's get to the trading diary. 11 a.m., about an hour from now, Prime Minister Rishi Sunak sitting down with President Biden at the White House. Salesforce holding its annual general meeting at 2 p.m. Next week, UBS could complete its Credit Suisse takeover as early as Monday. CPI on Tuesday, PPI on Wednesday, then a main event Wednesday afternoon. It's Chairman Powell and a rate decision with that news conference too. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
898, I won! Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumours that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking, and of course Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a national American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, after the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly